But it looks like they are now cut to underweight over at Morgan Stanley, again, on those potential capital requirements, whether or not the Swiss National Bank, and UBS by extension, can actually remain competitive. That's likely to move that stock this morning, Guy.
Okay, if you're excited about the gap between the FTSE 100 and the DAX, okay, we'll talk about that in just a moment. Let's talk about this market open and figure out what exactly is happening. We're not expecting some big moves here. We are expecting some moderate moves, but maybe the FTSE does deliver a little bit of outperformance versus the DAX. Anyway, the FTSE 100 is up a staggering 0.2% right now. We're expecting maybe a little bit more. We're expecting maybe 0.2%, but we're struggling to deliver that at the moment. In fact, we turn slightly negative. The stock 600 is out and is down by 0.1%. The FTSE regains its footing and is up by, I'm waiting to round up. Let's call it up by 0.1%. The IBEX is up by 0.2%. We await the DAX. So we can't talk about the spread yet between what is happening in the FTSE 100 and the DAX, Lizzie. I wait for that exciting moment when it arrives.
What we can talk about, Guy, are the UK banks. So you've got HSBC up 0.6%, about the same for NatWest. Lloyd's up 0.6% as well. Of course, we've got the stronger pound off the back of the inflation data coming in disappointingly sticky for the UK. But break it down by sector across the whole of Europe, and you've got about half in positive territory. Insurance at the top of the basket, healthcare at the bottom, Chrissy, autos not far behind.
Not at all. And I think it's really interesting because you are continuing to see a push into the energy sector. And I think that is at least one consistent theme that we've been seeing over the last 4 days. In fact, to the point that the defensive trade in this market, at least for the last 4 days, in the last 4 trading sessions, has ultimately been oil. And that's really just a reflection of the macroeconomics that you are seeing. But to me, the healthcare story is also very interesting. You point out that it's the laggard this morning. I'm looking at AstraZeneca, GSK in terms of the UK benchmarks, but also like some Novo Nordisk as well. That hasn't let up at all in the last 4 trading sessions. So you are seeing repetition in terms of what this trade is. But again, you mentioned the UK banks. I will mention UBS down almost 2% this morning is your biggest volume mover to the downside. And that again comes back to the very juicy topic of capital requirements, this time in Switzerland, Guy.
I'm going to talk about Airbus. I feel like I'm missing the Airbus story from the Dubai, from the Paris Air Show. We'll move on to the Dubai Air Show. It is the biggest points gainer this morning in Europe on the stock 600, up by 1.3%. Airbus has been briefing. It is talking about the fact that it is targeting a higher dividend payment and affirming its 2025 guidance, which is interesting because Thomas Hopper, the CFO, was the other day saying actually there's uncertainty out there at the moment, so maybe actually we don't lean on buybacks in the same way to conserve cash. But they're now talking about maybe targeting higher dividend payments, which I think is interesting, that maybe that is the way that they are going to go, and confirming 2025 guidance. There are so many imponderables in this sector right now. Huge amounts of demand, very much a supply-challenged industry at the moment. Don't know what's happening with tariffs, ongoing issues surrounding the supply chain story, ongoing issues from the airlines around kind of what they're doing in terms of airspace and things like that going on with the Middle East. So there's a lot of uncertainty in this sector. So it's interesting that Guillaume Faury is out targeting that higher dividend and affirming his 2025 guidance.
Uncertainty, of course, the cloud hanging over all of this. Let's bring in Jerry Fowler, Head of European Equity and Global Derivatives Strategy over at UBS for more analysis. Jerry, it's been a bit of a risk-off mood. You know, the stock 600 pretty steady, flat at the moment, and the rest of Europe trying to claw something back. But yesterday, certainly negative stateside. How long do you expect this cautious mood to continue as we wait for clarity over particularly what happens in the Middle East?
Yeah, I mean, the Middle East would probably not even be the most important thing for European equities in the next month. We've obviously got the tariff deadline coming in July 8. We've got the earnings season for the second quarter that will start in the middle of July as well, and that's going to be our first indication of what's happening with tariffs. So there's quite a lot going on over summer, and actually the Stock 600 trading at nearly a 15 times forward PE is roughly where we think it should be at the end of the year. And with discount rates pretty elevated, both risk premia and also risk-free rates, that's a reasonably rich valuation at the moment, especially when earnings are just being downgraded, left, right, and centre. So unless we see this earnings recovery or discount rates coming down, Europe's in a bit of a holding pattern with divergences.
Yeah, you've got a lot of people saying, put the Middle East aside. It was a time for a pullback on risk anyway. You've got so much uncertainty there. Was the market set for that pullback regardless?
Yeah, after a very strong rally, I think we were poised for not necessarily a pullback, but a little bit of a holding pattern. Because at least when we look at our tactical indicators for the US market, and obviously markets are obviously very correlated globally, we're seeing that there are still drivers of further upside, which includes that credit spreads or an element of risk premia were high and were continuing to come down, but weren't as compressed as they were prior to Liberation Day. In addition to that, mutual fund and hedge fund positioning is still fairly light, and actually, therefore, there is still buying. Plus, I think there's just a big momentum trade where everyone saving into their pensions is always putting more money into the same thing they bought last month. So that contributes just naturally some more flow into the market. So there are still some upside drivers, but certainly some of these risks just, it's a busy summer of risks, not just in Europe. In the US, you've got the budget, you've got the ex-date, you've got tariff deadlines that are important there as well. So there's just a lot going on that I think into summer is keeping people cautious, unwilling to sort of chase this rally, but equally, very few people really looking to sell at this point either.
I want to lean into your second title, which is head of global derivative strategy. Where do you feel like the hedges are most concentrated? What outcome are people bracing for the most?
It's a good question. I would say that hedging is really quite light, and in part because we have moved into an environment where hedging is done on a sort of a needs-must basis, because it is fairly expensive. And as I mentioned, positioning generally is quite light. So to some extent, with that very light positioning, there's often more interest in the upside hedge, making sure that if the budget does go through and it's stimulatory, if the US deregulation agenda continues, that you've got those US upside hedges. In Europe, it's the same, although it becomes a lot more nuanced because there are very clear headwinds to the earnings growth from tariffs and from currency, and maybe even for rising yields on certain sectors. So, things like pharma, luxury, household and personal products, food, beverage, tobacco, really struggling to maintain momentum, not necessarily going down, but they're not leading the market the way that defensives might in a risk-off environment. So again, it's positioning for some of that upside through banking sector or auto sector or industrial sector call options. So I'd actually say that very few people are really looking for downside hedges at this point.
I'll let Guy lean into the currency impact, but before I let him go into that, maybe we'll see. I want to ask you a little bit about the oil sector here, because of course we're watching this trade. Like I said, in the last 4 trading sessions, the energy market or the energy equities are magnifying the move that you were seeing on the macro, on the oil stocks as well. What is that multiple, if that makes sense? Yeah,
well, it's very hard to gauge. Excuse me. We have seen energy stocks bounce quite sharply when we've had geopolitical tensions around the world. But that also tends to fade quite quickly because, by and large, there is quite a lot of oil out there that can be supplied. OPEC has been constraining it. They are starting to release more of it. So it's, finding the right level of supply and demand balance when there are artificial constraints is quite difficult in terms of understanding where the oil price itself should settle. But nonetheless, we've had a prolonged period of earnings downgrades for these energy companies, in part because of the low energy price. So at this stage, we still have energy as an underweight sector in Europe, because we're expecting that this bounce might be short-lived, as previous ones have been, and that the negative earnings revisions are still enough to overpower what is a reasonably high free cash flow sector, particularly at current oil prices.
Do we need known knowns before we can start acting on what the information that we have? How high is the bar for a piece of information to become actionable at this point?
Yeah. So with the level of uncertainty we've had in the first 6 months of this year, analysts and economists really aren't moving their numbers until it's a fact that something is happening. So you saw that with Liberation Day. Everyone knew there were going to be tariffs against Europe. Yeah. But analysts weren't downgrading their earnings estimates because they didn't want to guess what those tariffs would be. So then you get the announcement, and they're a particularly high level of tariffs. Then you get a broad swathe of downgrades. It's the same sort of thing with US GDP. You know, there was a lot of evidence US GDP should slow or would slow with tariffs.
Yep.
You didn't really get those GDP downgrades until you got the announcement. So it's very, very difficult to forecast things. I mean, even if we just look at our GDP forecasts and put them in the context of all the different scenarios about how the current tariff setup would play through, we've got a range of sort of +5 to -3% impact on US GDP because we just don't know how it plays through.
So given that, the market is normally a forward discounting mechanism.
Should be, yeah.
Yeah, but is it acting? Is the market pricing in now, or is the market pricing in 3 weeks from now, 6 weeks from now, 6 months from now? Because it normally prices, the equity market in particular normally prices forward.
Yes, correct. And I would say that ordinarily the market might try to price 3 to 6 months forward in a less volatile environment. It feels a little bit now that might be less than a month. And even then, the distribution of outcomes on a shorter horizon is just much wider.
Yeah.
So if you widen that, you've got sometimes more volatility. So we have seen volatility spikes that can be very large when you actually have the news flow. But probably what's important is just that volatility itself can whip about. Sometimes it can be very low, and then other times it can be very high, and it can swing back and forth. And that means that it's rather difficult to time things like, do you want to be overweight cyclicals or defensives?
Yes.
Because that trade relies a lot on understanding the regime of volatility.
What about less tangible stuff, less precise stuff? Like, you know, you've talked about underpricing the momentum behind Ursula von der Leyen at the European Commission, and actually that there should be more upside seen from what she's doing in terms of competitiveness. What are people not seeing that you are?
Yeah, so even in Europe, there's quite a lot of skepticism that the Draghi report will make any meaningful change anytime soon. And outside of Europe, there's almost no awareness that the European Commission in von der Leyen's second term is quite different to the European Commission in her first term. There's a lot of very high-level people with specific tasks to implement elements of the Draghi plan. So we're doing work on that at the moment. We've got an expert call for our investors today, which I think is going to be very interesting. I've done the pre-call with him already. There is a lot of work under the surface to make Europe more competitive. It's almost like Europe's third era after creating the European Union, creating the euro, and now Europe becoming internationally competitive rather than focusing on domestic internal competition.
But is it that people don't get it, or is it they don't believe it?
A little bit of both. A little bit of both. I would say there's very low awareness. I mean, everybody knows the names of many people in the US cabinet. Almost no one knows the names of anyone in the European Commission.
Well, there are many.
Yeah. So there is an element of lack of awareness. But then also there is just this element of, gosh, there are so many different layers in the European political system. You've got the national governments, you've got the European Commission. You know, will they actually get these things done? But for the first time, there is a really clear structure of Draghi report task forces within the European Commission and national governments that hopefully make this happen over time.
How do you trade that, though?
It's going to be hard to trade because it's relatively difficult to see specific concrete actions apart from the defense plan and the clean energy, you know, the big things. But the competition policy, I think, is going to be a really important one. We should see more mergers being approved. We should see more state aid being approved. And that'll be relatively important for some of these key themes like clean energy. And from that, we should see sales growth and margin expansion for a variety of companies. Probably the first place we'll see it, particularly because interest rates are coming down, is loan growth. If the banks are growing their loans, we should see, you know, reasonably strong evidence that Europe is improving.
I just come back from the Paris Air Show. My biggest takeaway, one of my biggest takeaways was the French are on a different page to the Germans. And the French are on a different page to the Brits. The next generation fighter aircraft that we're going to be talking about. But rather than the specifics, it's just the French still see the need for a national competence in this space, in defence. We are going to build our own fighter, potentially, rather than building a European fighter. The US builds maybe 2 or 3 fighters, but they build a lot of them, and it's very focused. We don't seem to be getting away from this yet. So, yes, I hear what you're saying about the Draghi report, and I hear what you're saying about core competencies, but this national, supranational tension is still going to be massive within Europe, and it feels like it's a real struggle to get over that, certainly in the defence space.
I think that's right, although there is definitely now a European imperative to try and improve that. And really, Airbus is an example of how that can work, because Airbus does actually produce its parts all across Europe and bring them together.
But that's civil, and that's easy. That's not... Yeah. Yes, there's an industrial base that comes with that, which has a defensive element to it. But core competencies in defence feel like they are different to core competencies in civil. Building an Airbus of defence feels like a much different, more difficult job than building it on the civil side.
Yeah. Perhaps in that case, it'll be a matter of the European, community deciding who builds what and sharing it. So maybe it's the French build the fighters, and it'll be very interesting to see how it plays
your
out.
optimism.
There are, and this comes back to the European Commission. There is now a European Commissioner focused on defence integration with counterparts in every national government. So it's a reasonably difficult conversation, I'm sure, but Europe is ready to have that in a way that it hasn't been for a long time.
Okay. We'll see what happens. Jerry, I look forward to
You're not holding your breath
later. Jerry Fowler, Head of European Equity and Global Derivatives Strategy, joining us from UBS. The Core 6 looks like this morning. Let's take a look at what the story is. Some of the most important stocks in Europe. The defences are off a little bit. You've got Pharma actually down. You heard what Trump had to say on that space. LVMH, Ferrari, ASML catching a little bit of a bid. But the market's still struggling, I think, from a sort of sector point of view, from a rotation point of view, again, to find something concrete to work with. Let's see what else we're watching. Joe Easton has the details.
So Airbus, Guy, as you've been discussing there, is having a strong start to this session on the backdrop of the Paris Air Show, of course, and this raised dividend target, so predicting dividend payouts rising around 50%, up from the previous target of up 40%, and also reiterating a lot of their targets, saying they're going to sell around 75 of the A320s by 2027 was a key line I read in that report, but extending gains, and actually the best performer on a points basis, as Guy mentioned earlier, so a pretty decent start for Airbus today. Then in terms of M&A, Gerresheimer, now this is the German company that makes a lot of the components used by Novo Nordisk and other weight loss diabetes drug makers, so actually making the injectables, and there's takeover talks ongoing on this one. We had a bit of back and forward yesterday around whether one of the parties involved has walked away, but Gerresheimer actually saying still talks are progressing. Warburg involved in that, KPS Capital as well, so getting a rise on that one, pairing the losses we saw yesterday up almost 4% on that one. Then in the UK, AO World. Now this is interesting because they were talking about people not upgrading their mobile phones as much as they had expected. So mobile phone sales not actually doing as well as expected, but the stock actually holding up. It's the AO.com operators, so maybe everyone upgrading their dishwashers and washing machines, that kind of thing, but not selling as many mobile phones, but the stock holding up. And as we got down to the bottom, they're actually beating expectations on the profit line. Then Ocado, they've got a new fulfillment centre out in Catalonia. That was actually one of the best performers at the open of trading, kind of showing us how there's not many stocks actually doing that well today. But given there's so much uncertainty on the Ocado automated factory business over the past few years, that's really been the big uncertainty. Just getting that news of one fulfillment centre, one factory over in Spain is actually lifting the stock, providing a bit of certainty for those investors. And then to finish, UBS, as we mentioned earlier, cut to underweight. Now, as Kriti was discussing earlier as well, it is all related to this capital issue and the Swiss government telling them to keep more capital on the books. So Morgan Stanley going underweight, but the price target only 26 francs. We can see that's pretty much where it's trading, so they don't see a lot of downside, but it's another sell rating, and UBS stock declining 1.3% in Zurich this morning.
All right, Joe Easton from our equities team walking us through some of those early movers. We thank you so much. Coming up, we're going right back to a little bit of the macro here. The Fed expected to hold rates steady as President Trump's trade policies cloud the outlook, not to mention the geopolitical volatility out of the Middle East. We're going to dive into the details next. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back to the opening trade. About 20 minutes into today's session, marginal moves on the upside and downside. But your outperformers, the FTSE 100, higher by about 0.2%, and the energy complex really helping that index, but again, by a very, very small margin. In the meantime, all focus, of course, on the Federal Reserve, perhaps how they're going to be reacting to the geopolitical tensions in the Middle East, not to mention the trade negotiations of the last month or two. Fed officials widely expected to leave interest rates unchanged for a fourth straight meeting later today. Meanwhile, President Trump's trade policies, as I mentioned, also adding uncertainty. So how do you think about it? Bloomberg's Valerie Teitel is here with all the answers. Val, what is Jay Powell thinking?
That's a very good question, Critty. I wish I knew. I would make a lot of money trading these markets if I did. But essentially, in today's decision, it's going to be a lot of nuance. It's going to be the details in the economic projections. We do get their economic, their inflation and economic growth projections. We also get the updated dot plot. So it's parsing those two things together, because what we're really trying to figure out here is who on the Federal Reserve Board thinks that this tariff-induced inflation is transitory and still believes the Fed can continue this cutting cycle, versus who believes that this tariff-induced inflation could cause persistent inflation and maybe take this cutting cycle to an end. So it's going to be kind of the nuance in the dot plot. I, for one, am going to be looking out for how many FOMC members are penciling in no cuts throughout the remainder of this year, and if that number keeps growing.
Okay, the other thing that's on the Fed's mind is on the 25th of June, they're going to meet to discuss SLR and this plan of US bank regulators to cut the key capital buffer, because essentially they think that it's holding back Treasuries trading. Interesting that stocks reacted more to this news than bonds.
Well, look, I think the reason why we haven't necessarily seen a big reaction in the Treasury market from this source Bloomberg article about this bank capital reform is it didn't necessarily go into any color about certain carve-outs for the Treasury market. We were hoping to maybe see the Treasury market carved out completely from SLR and allow banks to not have to treat Treasuries essentially as a risky asset and hold capital against that. It seems like from what we're hearing from sources that they may ask for public comment when it comes to regulation for the Treasury market. So maybe they've not made a final decision yet, but even that maybe is a bit underwhelming for the Treasury market that really wanted to see some positive reform. Because again, we keep asking these questions. The more the government spends, the more you need an incremental buyer of Treasuries, and perhaps U.S. banks could be that incremental buyer if we get...
This will certainly help the government in terms of its issues. My question is, but given that backdrop, yeah, if I'm a bank, I can own more Treasuries. do I want to own more treasuries?
Well, it's not necessarily about wanting to own, because this is about facilitating liquidity when it comes to a trading desk. So when the market is all one direction, like it was in April, you had huge amounts of selling of treasuries. Someone has to absorb that flow on the other side. And the fact is that the banks were less willing to absorb that selling flow because they were worried about their balance sheet and they were worried about the risk.
But aren't they carrying more risk? Given the nature of the Treasury market has changed.
Yeah, that's definitely true. The nature of how Treasuries have been reacting it has been different, right? Normally, when the U.S. economy slows down, we see Treasuries rallying. We've not necessarily seen that this year. Instead, we've seen the opposite. We've seen Treasury long-term yields rise. So, yeah, there is definitely a lot of funky things in the Treasury market that have been going on in the last year and a half, but facilitating liquidity for trading desks is maybe something that's a different factor.
Okay. Let's bring in another element to all of these conversations that we're having. The U.S. Senate has passed a Trump-backed stablecoin bill in a win for the crypto industry. Charlie Wells is here with the latest. Why is this a win for the crypto industry?
So in a weird way, the crypto bros kind of wanted to be regulated, like just enough. Yeah. And this is very much kind of Trump-backed. This is the sort of thing that they wanted. And basically, it helps to bring crypto, at least stable coins, mainstream. Because basically what it is saying is that these stable coins, if they promise that their stable coins are going to be backed by, say, $1, they've got to have that $1 either in cash or in treasuries. So this is the main takeaway from that, but also it kind of subjects stablecoin issuers to some of the issues that banks have had to deal with, right? So complying with anti-money laundering rules, with sanctions, but basically bringing these into the mainstream.
Talk to us about how this actually shows up when it comes to, I mean, you talk about the mainstream, but within the crypto space itself, can you explain why stablecoins are so important?
Well, there's even kind of, a little bit of a Trump theme here that I'll get to, but the reason why these stablecoins are so important is because crypto traders like to use them as a store of value, right? Because in the name is the word stable. We know that so many of these other cryptos are the complete opposite of that. So it basically allows you to have some stability, some store of value while you're trading these other much more volatile cryptos. And this could be good within the U.S. crypto industry. There's that Trump theme. Circle, the largest issuer of stablecoins in the U.S., just went public, and they've been performing pretty well. Let's see what happens later today, but this is definitely a win for them. And this industry spent millions on the most recent election. It's looking like they're going to spend even more on 2026, or at least significant amounts in 2026. But again, this bill heads to the House. So a lot of people expect it to pass, but still, again, this is ongoing legislation.
Charlie, speaking of the bros, you've got OpenAI CEO Sam Altman saying that Meta's offering his staffers $100 million signing bonuses, but he's not worried, he says, because Meta just doesn't get it. Is that really just tech bros trading barbs and we can kind of ignore it?
I mean, look, the race for talent in AI is heating up, and executives have told Bloomberg that some of these signing bonuses actually could make sense for these firms just because there are so few people who could actually do a lot of this AI work, which makes me question a lot of the decisions I've made in my life. Why did I not study computer science?
Because it's really hard.
Yes, exactly. And people are willing to pay a premium for it. So, this is Meta really looking to kind of bolster their talent. What's interesting is, Meta has the chips, they've got the data that they need, but the talent is something that Mark Zuckerberg really has been hunting for in the past few months.
All right. Charlie Wells and Valerie Titel walking us through those dynamics. Lots of legislation, coming out of Washington, D.C., and having people on their toes, although we're not seeing a general market reaction just yet. Maybe we will in the next couple of weeks. Coming up, we've got two major topics that we're going to be talking about. We're talking about the oil markets, the geopolitical volatility as well, and how it all shows up in these private markets. We have an exclusive conversation with Anuj Ranjan, the Brookfield PE CEO. Maybe how you navigate the private markets despite all the volatility. That conversation coming up soon. This is Bloomberg.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with more episodes of our show, The Deal. the theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome back. You're watching the opening trade. We are 30 minutes into the session. Absolutely no movement on equities. We're waiting for the Fed, waiting to see what the US does on the Israel-Iran conflict. So we're waiting for all of that. In terms of what we are seeing out of the Riksbank, we've actually got some news. There's some news happening right now. Pay attention. We've got a 25 basis point cut coming through from the Riksbank. The Swedish economy is beginning to slow a little bit, and there's all kinds of factors that you need to sort of roll into that. As we know, what's happening on the tariff front, generally kind of what is happening with the global GDP picture. But the Riksbank has decided that this, at this point, merits maybe picking up the pace a little bit. So a 25 basis point cut coming through. You can see the reaction in Euro Stocky this morning. A stronger euro coming through in reaction to this. Sees GDP growth 2026 at 2.4. That is pretty much unchanged. It has, though, dropped the 2025 GDP expectation. Did see 1.9 back in March. Now sees 1.2. So we have seen a little bit of a drawdown in terms of the growth expectations coming through from the Riksbank. So they have decided to act, a central bank that is acting, delivering a rate cut. Exciting.
And maybe leading the pack. I mean, look, we have the Bank of England tomorrow. We have the Swiss National Bank tomorrow as well. They're all dealing with the same. Well, the Fed I'm putting on pause because they'll be on pause.
Sure. At least the BOE, but maybe the tone.
The tone, right. And this idea that their growth is slowing down, the very elements that Guy was just talking about. And perhaps we do see that dovishness, especially because part of the Swedish economy is kind of Achilles heel at the moment. That so much of the manufacturing weakness is driven by trade policy uncertainty. And I think that might be a theme that we see certainly in the Fed, but also in the BOE tomorrow.
Yeah, the Riksbank saying as well that they see some probability of another cut this year. So we keep an eye on that, as you say, Critty. Maybe the weather vane for the rest. But in the central banking space, of course.
Well, you could argue the ECB is the weather. The ECB has been the one that has the Riksbank as well, but the ECB has cut quite aggressively already and is coming to the end of a cycle. Whereas you kind of feel like the BOE and the Fed are sort of still mid-cycle, can't decide what to do next because they've got a different inflation story that the ECB and maybe to a certain extent the Riksbank is factoring in as well.
And now they have to think about what's going on in the Middle East and the oil prices.
Indeed they do, and particularly the nuclear story, because Donald Trump has held talks with his national security team now that he's back from the G7, and that's fueled speculation that the US is about to take a more active role in Israel's military action in Iran. Bloomberg understands that yesterday's meeting in Washington lasted more than an hour, and it was followed by a call with the Israeli Prime Minister Benjamin Netanyahu. Now, earlier, the US president had posted on Truth Social calling for Iran's unconditional surrender and that America's patience was wearing thin. Let's bring in Bloomberg's Jomana Basechi out of Dubai with more here. Jomana, just at the moment, what are Donald Trump's options?
Yeah, well, ever since President Trump departed that G7 summit early yesterday, there has been rampant speculation about what the U.S. are thinking and whether they are going to go down the route of getting involved militarily in Israel's campaign against Iran. And it seems as though Trump's own advisors are pretty split on this topic. You mentioned there yesterday that he had an over 1 hour long meeting with his national security team. There was no statement put out after that meeting. He also had a call with the Israeli Prime Minister Benjamin Netanyahu. Again, no readout of that call either. But as of now, he's got essentially three options. One is do nothing, which is in reference to a comment that he made on Sunday saying that the two sides may need to, quote, fight it out for a little bit longer. He also may use this weakness in both Iranians' military defense systems and nuclear facilities to create a window of opportunity to restart those nuclear deal discussions under perhaps more onerous terms, i.e. pursue the diplomatic channel, or the most hawkish option would be for the U.S. to decide to get involved militarily, perhaps lend some of their munition to the Israeli side to help with the targeting of some of those deeply embedded uranium enrichment sites. We've been speaking about Fertile the last couple of days. Only U.S. munitions are capable of taking out that particular site. But so the question is, not only do they get involved, but then also, I would say, how do they justify it, especially given back in March, the Director of National Intelligence, Tulsi Gabbard, testified in Congress that Iran's supreme leader had not authorized the resumption of nuclear weapons program. They suspended that back in 2003. So it's not only about whether they take a decision to get involved militarily, but how they can justify it back home as well.
Jomana, how is this being received by the Gulf countries, in the UAE where you are, by Saudi and by others? How are people thinking about this in the region?
Look, there is an extreme amount of anxiety, as you can imagine, because it's essentially happening at the doorstep. There's only a very thin piece of water that separates, land of water that separates the region, the GCC region, from Iran. We've talked a lot about Strait of Hormuz and the potential disruption that could cause. And remember, for many of these GCC nations, and you don't have to go that far back, President Trump was in the region a month ago talking about the new dawn of the Middle East, the new face of the Middle East, the economic programs that all of these countries are undertaking. And one fundamental cornerstone of these projects is political stability in the region. And the Gulf states have been consistently calling for a de-escalation. It's also one of the reasons why back in 2023, you may recall, Saudi Arabia actually did mediate, did restore diplomatic relations with Iran in anticipation of a potential conflict rising again because of all of the actions and the words that Israel have been putting out in the last couple of years. And so there is a lot of tension in the region, but generally they've been, one, condemning the strikes that have been taking place, and two, looking for a diplomatic channel.
But is there a perception, Jomana, maybe a growing perception, that regime change is possible? We heard the President of the United States talking about the idea that he knew where the Supreme Leader was, that he was potentially a target. Is there a sense that regime change could be possible? It's something that's been talked about for so long, but has been very hard to achieve. Is that now part of the narrative within the Gulf? For people, and how would that be welcomed? Would that be seen as destabilizing the region or providing more stability were we to see that regime change?
Yeah, I mean, you also need to remember that Iran is the most populous country, Egypt aside, obviously, but 90 million people live in Iran. And the question of change of regime forcibly is one that creates a lot of uncertainty. You don't have to go that far. President Macron yesterday speaking about it on the sidelines of G7, saying that this could bring about chaos. You don't have to go that far back in history. Think about what happened in Iraq after the 2003 military intervention. Think about what happened to the Arab states after the Arab Spring of 2011, the chaos that ensued in Libya. Even today in Libya, there are warring factions, warring tribals. There's no clear government that is perhaps representative of some of the liberal democracy that the West would like to see instituted into these countries. It's not easy to bring about regime change, and I think the perception from the region is if it is going to be done, it has to come from the people. There's no credible opposition right now in Iran because there hasn't been allowed for a credible opposition to thrive. So these are big questions, and I think are very fundamental questions to the future of what actually is at stake for the U.S. if they decide to get involved militarily right now.
Jumana, thank you very much indeed for the update. Jumana Basenji joining us from Dubai as we await news on that front. The IDF has indicated, the Israeli Defense Force, that it has attacked a Iranian uranium centrifuge production site. It has done so this morning. What is the current state of the Iranian program? Daria Dolzikova, Senior Research Fellow of Proliferation and Nuclear Policy at RUSI, the Royal United Services Institute, joining us around the table. Good morning.
Morning.
What do we know?
We know a lot, but at the same time, not very much, because a lot of it's not entirely confirmed. So we're having to piece things together. So what we know in terms of what they've attacked is the Israelis have attacked a number of facilities across Iran, nuclear facilities. We know they've targeted the Natanz enrichment complex. So that's where the uranium is actually enriched, which is what you need to do to essentially get it up to the level that it needs to be for weapons production. We also know that, by the sounds of it, they've targeted, as you said, a centrifuge production facility this morning. So that's the equipment that Iran would be using to actually engage in the uranium enrichment. There's a few other sites around the country that they've targeted. But again, we're sort of still piecing things together.
How debilitating are these attacks, and are they debilitating enough for Israel to feel that it's done enough damage? What is enough damage? What takes the nuclear weapons program offline to a sufficient degree that Israel's going to be satisfied?
Well, that's the big question. How much is going to be enough for Israel? Because the program, as I said, is very dispersed. A number of the facilities are very hardened as well. And it's a very advanced program. Oftentimes you hear comparisons with the Israeli attacks on the Iraqi reactor in Ozark in 1981, or the Al-Kibar reactor in Syria in 2007 as successful counterproliferation strikes. This is a completely different universe. The program is very, very advanced. So to roll it back militarily, not only would you have to target numerous facilities, like I said, some of them quite hardened, but also you'd have to eliminate the expertise in the country. So I think at this point, we're talking about gradations of damage rather than a full elimination.
What does that mean in terms of the precedent that it sets for other nuclear programs around the world?
Yeah, that's a good question. And I think there's a few things that other countries will potentially be looking at. Certainly, this will, I'm sure, be a disincentive for countries that might be looking to put forward advanced nuclear programs without the degree of cooperation with the International Atomic Energy Agency and the degree of transparency that the agency and the whole international community has been demanding to make sure that the program is peaceful. I think the other thing to keep an eye out for is what Iran decides to do with the Non-Proliferation Treaty. So that's the treaty that's underlying the global non-proliferation regime. It's still a part of that treaty, but there is some debate in Iran on whether or not to pull out of that treaty. And the question then becomes, how do other actors in the region or globally start to think about, okay, is Iran now a threat to us, and do we need to start thinking about our own nuclear programs? I think that's a way off, but probably something to consider.
There's something else people are talking about in terms of proliferation treaty is simply that if we go to some sort of era where elements of the initial JCPOA come back onto the table, and that was something that the Europeans had a much bigger hand in then than they do obviously now, is that a viable possibility?
The JCPOA was concluded in 2015. I think we're so far beyond that now. Both the Americans they pulled out of the treaty, so the Iranians didn't get the economic benefits that they were expecting. But also the Iranians have violated the provisions that they were bound to such a degree. I mean, we're talking about enrichment levels well above what was in the treaty, the agreement. The agreement capped enrichment at 3.57. We're at 60% now. The amount of stocks of uranium that have been enriched and stockpiled, the types of centrifuges that are being used, I think we're well beyond the JCPOA. There's bits and pieces that we could potentially use as a future framework, but I don't know what the prospects for diplomacy are at this point.
But if Iran does withdraw from the NPT and its nuclear program is driven underground, metaphorically, and I know we've got to, gauge what the damage has been, how long does it take Iran to get back to pre-Friday levels? Is it weeks? Is it months? Is it years?
That's really hard to assess, partially because we don't actually know what the extent of the damage is. We know which facilities have been hit. We know we have confirmed elimination of certain facilities, so the above-ground enrichment plant at Natanz, but the underground facility at Natanz, for instance, we don't know the extent of the damage there. It's also early days. Israel keeps threatening to try to eliminate Fordo, which is the deeply buried facility. That would take most likely American involvement, but again, that could roll the program back further. So it's a bit hard to assess at the moment how much damage has actually been done.
And what are the risks for, say, the UK, given it's got forces across the Gulf, but it has almost no missile defence in the region?
Sure. So I think that's certainly a consideration. I think that'll become a bigger concern if the Americans potentially get involved as well. At the moment, this is a conflict between Iran and Israel. But as I was saying, the Israelis might push for the Americans to try to get involved to eliminate some of the more hardened facilities. And if that happens, I think then we're looking at a broader expansion of the conflict across the region, which might pose threats to American but also other assets.
I mean, I know through your expertise on nuclear, you've kind of become an expert on Iran as well. Just to Guy's earlier point, do you see this ending with regime change?
That's really difficult to say. I mean, the Israelis, the number of targets that they've hit, to me suggests that the intent is not just to eliminate the program, that it's to destabilize the regime. They said that regime change is not necessarily the objective. But I think we are in a universe where you could imagine instability becoming sufficient, especially if strikes continue across the country and against key political and other assets. Then it's hard to say.
Have we reached the limits of what the Israelis can achieve without the United States being involved, and i.e. with the larger ordnance that may be required to reach the depths of the hardened bunkers?
So when it comes to the nuclear program, yes, it would be hard for Israel to penetrate the hardened facility externally, but the Israelis have also been very good at carrying out what you would call, I guess, sub-threshold or covert activities as well. We don't know what access they have to Fordo, to that hardened facility from the inside as well. They've penetrated other Iranian facilities before. It is in the realm of the possible that they could find some other creative way, basically, to get into the program.
Okay, Daria Doltsakova, we thank you, taking us through the many unknowns, a true expert, Senior Research Fellow of Proliferation and Nuclear Policy over at RUSI. We thank you. Well, coming up on the programme, we did talk private credit in the first half of the show. We're going to turn back to it, and we'll turn our attention to private equity. Brookfield's Anuj Ranjan joining us around the table next to stay with us for that exclusive conversation. This is Bloomberg.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like
100
hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jumana Bersachi in Doha, Qatar, and this is Bloomberg.
So this morning's news flow is a lot about balancing the volatility coming out of the Middle East, still thinking about trade negotiations out of the United States, and also a little bit of asset allocation. You look at these public markets, they're not moving a ton today, which I think is a great moment to take advantage of and evaluate the private markets. We have the perfect guest to do that. Anuj Ranjan, CEO of Brookfield's Private Equity Group, joins us right around studio. Thank you so much for joining us this morning. We're talking a lot about the volatility. We're trying to kind of piece together what security risks in the Middle East mean, what trade negotiations mean. And in that front, we've seen kind of a freeze in capital markets, or at least a pause there. We've seen a little bit of a pause in public markets as well. Is that showing up in the private markets?
Well, I think, first of all, thank you for having me back. And I think the word you used was perfect, moment. Moments like this are those that separate investors from observers. This is the time, we believe, to not be on the sidelines. This is the time to actually deploy capital. History and experience has often showed us that if you invest in times like the one that we're in right now, the next decade of returns are often reflected. And so for us in particular, and I'd say for the market in general, what we're seeing is real opportunities coming out of some of this uncertainty.
Opportunities where? What side of the Atlantic?
We're seeing it across the world. The nice thing about us is that we're quite global. We have a big presence in the United States, where we've been from our foundation and our entire history. The U.S. remains one of the most attractive markets to invest in the world, we think. It's a real industrial powerhouse, and there's real opportunities. But here in Europe, we're seeing some exciting new opportunities emerge as well. We're investing across, I'd say, traditional industrial businesses that form the backbone of the economy, those that provide essential products and services that are less cyclical in times of volatility, can kind of make it through any cycle and generate a ton of cash flow.
If I put money into a fund now, in 7 years' time, am I going to get that money back? It's the key question that everybody keeps asking about private equity. It's just exits. Where are the exits? How do I manage the flow within the industry? Yeah, we can take more money in, but does the money come back out again?
It's a great question, and I'd say when you think about private capital, private equity more broadly, it's hard to paint it all with one brush. As an example, we've returned $10 billion over the last 18 months. Exits are there. A good chunk of the private equity market was in businesses that were predicated on growth, low interest rates, and higher exit multiples in order to make their returns. Those are the businesses where I'd say owners are probably sitting on the sidelines and not exiting because they're not getting the valuation that they would like. When you own essential services, when you own industrial businesses that make essential products that generate cash flow is always.
Where are those exits happening? You talk about those exits. Are they within private equity, i.e. other funds buying, or are they going to trade buyers, industrial buyers who are looking maybe to roll up and scale up?
Yeah, we've seen that the strategic bid is back. Strategics, industrial corporates are buying businesses that they think are an essential part of their portfolio that generate a lot of cash, that are very financeable. That's a key point. The credit markets need to be able to finance these businesses in order for them to be transactionable. And today, businesses that generate a high degree of cash flow in a sustainable fashion they're getting financing, and therefore they're getting bids. And so most of our exits have not been to other private equity.
Right.
They've not been to the public markets. It's primarily been to strategics.
Yep.
But Anuj, how do you value businesses right now? How do you even begin to value businesses right now when you've got so much flux, when it's the geopolitics, as Chris was talking about, or in the rate environment, as we're looking at the Fed later on? We just have no idea what's happening with inflation. So how can you put a price on anything?
Yeah, if you think of it purely as a cost of capital, it is hard to pin down a specific maybe cost of capital to look at the future cash flows with. I'd say the way we think about it is we want to own businesses where we are the best owner, where we can operate them better than anyone else could, and where we will generate our returns is through margin expansion, not multiple expansion. So the phrase I like to use is we're going from roll the dice private equity to roll up your sleeves private equity. And all private capital investors need to actually invest in areas where they have an expertise far better than anyone else.
So you talked about essential services. I know that you've got some personal expertise in AI from your former life. How does that fit into how you invest in essential services?
Yeah, look, my personal experience in AI is 25 years ago, so it's quite dated. But I would say that I was probably 25 years too early in that industry. Today, what's amazing is we are definitely accelerating into the fourth industrial revolution. But unlike the steam engine, it's happening a lot faster. And the key word of fourth industrial revolution is industrial. These industrial businesses need to see significant productivity gains in order for all of this technology investment to be worth anything. And what we're seeing for the first time, I'd say a year ago, it felt like there was a lot of talk, but the technology had not yet caught up. Today, we're seeing real use cases in our businesses, in our factories, whether it's automation, whether it's advanced robotics, or just general applicable artificial intelligence. In my opinion, using AI as a productivity tool, as another tool in our toolkit to reshape the companies we buy and remake the companies we buy and enhance margins, that's the best application of it.
Let's lean into the conversation about industrials specifically, and this Europe's moment to shine, if you will. How much of that bull case in the value proposition of Europe right now is really hinged on fiscal spend? And I ask this in the context of Germany's massive fiscal impulse. You're seeing it matched in other places, but not to the same extent. What gets in the way of that?
The capital spending programs and some of the CapEx that's going into the market will really boost activity across the whole continent. We think it's a key component of investment. And what the thing is that to make these capital commitments that the governments need to, private capital can actually be a great partner. We've seen opportunities that we've done in Sweden and in France on more digital infrastructure, where private capital partners can actually form partnerships with the government to invest in their local markets and help them grow their economies. I think we're moving away from traditional just leverage buyouts as a form of private capital. It's actually now about government partnerships. It's about partnerships with exceptional institutions.
Well, Anuj, let me just for time very quickly. When you see a potential press on those fiscal impulses, let's say a recession hits, let's say some of those spending priorities change, would that change the thinking from a PE firm like yourself?
It doesn't change the thinking because we like to think in multiple decades, not a very short period of time. And thankfully, geopolitics keep changing, but our view of businesses usually don't. We want to find great businesses to generate a lot of cash flow that we can buy and improve. That's number one. There might be some change in the nuances of markets we look at, expanding into markets that micro markets that we want to spend capital in. But overall, our view is we're here for the long term. We've always invested for the long term. If you buy great businesses that are market leaders, they can usually make it through any cycle.
All right. Anuj, pleasure to have you on the program. Thank you so much for joining us. Anuj Ranjan, CEO of Brookfield's Private Equity Group, walking us through some of his thinking, how he's approaching the value side of his business, but of course, how he's approaching Europe versus the United States as well. In the meantime, if you look at these markets, it is kind of cautious. A cautious optimism, I think, is the way I'd phrase it. Some green on the screen across the board when you look at the DAX, the CAC, and of course the FTSE 100, but again, not by a massive margin. A similar story over in the bond market. I'm looking at a 440 on the 10-year yield. Even oil prices not moving a ton, still a 76 handle on Brent. Lots to go through, lots to monitor. That does it for the opening trade. The Pulse is up next. Stick with us. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bring you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne Ruhodern in Buenos Aires, Argentina, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Speculation grows that the US may join Israel's attack on Iran as President Trump met with his national security team after calling for Iran's, quote, unconditional surrender. In markets, oil hovers near a 5-month high on the escalating Middle East tensions as investors also look ahead to today's Fed rate decision. Plus, Meta's millions, OpenAI's Sam Altman says Mark Zuckerberg has been poaching AI staff with signing on bonuses of as much as $100 million. Let's check in on the markets then with the Middle Eastern focus, of course, and the run-up to that Fed decision. Jay Powell and team at the FOMC expected to remain on hold with rates for the 4th consecutive meeting. It's what Jay Powell has to say about the path ahead and the updates around the forecast, particularly on inflation, the jobless rate, and, of course, the dot plots that will be in focus. S&P futures now pointing to gains of 0.2%. We saw losses of around 0.8 by the end of the close yesterday. Will the Fed be the catalyst amidst the Middle East uncertainty? The US 10-year at 4.39. We watch movements, of course, across the Treasury curve on the back of anything that Jay Powell has to say later today at the press conference. The pound is getting a bid up 0.2% at 134 on stronger inflation, CPI coming out at 3.4%, the highest levels in a year, and posing a conundrum, arguably, for the BOE, particularly in light of the high oil prices. With that meeting from the Bank of England tomorrow, $76 a barrel on Brent. We have seen that fluctuation. It's been moving around a lot, the oil price, currently down 0.5% at $76 a barrel, but as we said, still near those 5-year highs. Let's flip the board, 5-month highs, I should say. Let's flip the board and check in on what is transpiring across the European space. You're seeing the CAC current up 0.2%. The DAX also gaining 0.2. Here in the UK, the FTSE 100 up 0.2%. So a bit of a reversal in terms of sentiment. Very, very modest optimism in some of these key markets. Worth noting that over in Switzerland, the SMI is currently a little softer by 0.2%. The conversations, the analysis starts right now.
Newsmakers and market movers. This is The Pulse with Francine Lacroix.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London. These are your top stories. Donald Trump then has held talks with his national security team, fueling speculation that the US is about to take a more active role in Israel's military action in Iran. Bloomberg understands that yesterday's meeting in Washington lasted more than an hour and it was followed by a call with the Israeli Prime Minister. Earlier, the US president had posted on Truth Social calling for Iran's unconditional surrender, saying America's patience was wearing thin. But the French president has warned the US not to force regime change in Iran.
No to military actions aimed at regime change, because no one knows what comes next. Haven't we collectively seen the consequences this has had in the region and beyond? Does anyone think what was done in Iraq in 2003 was a good idea? Does anyone think that what was done in Libya last decade was a good idea? No.
Well, let's bring in Bloomberg's Jumana Basechi out of Dubai. Jumana, what are the options then open to Donald Trump as we await what seems to be potentially a momentous, potentially an historic decision from this US president?
And certainly people have been waiting to hear what that decision is going to be after President Trump departed that G7 summit early. We know that yesterday he had that call with his national security team. It lasted over an hour. That was followed up by a phone call between himself and the Israeli Prime Minister. There was no readout of that call, no statement put out after the national security meeting. But what we can glean is from his Truth Social post, because if you rewind back 24 hours ago, he talked about looking for something, quote, larger than a ceasefire, i.e. perhaps had reopened the potential for a diplomatic solution, taking advantage of Iran's weakness at this point in time to perhaps push them to sign on to a more stringent nuclear deal. But the tone has changed just overnight. He put out several posts demanding Iran's unconditional surrender, calling the Ayatollah an easy target, and also warning the Iranian side to surrender to the terms and using the plural form, the word we, saying we have control of the skies, suggesting that U.S. are somewhat involved already. Now, the question from here is whether they're going to opt for military intervention, what that looks like exactly, what will be the extent of the involvement in the U.S., whether they'll participate in the hitting of those nuclear sites, but then also, Tom, what the justification is, given that the U.S. Director of National Intelligence back in March actually testified to Congress that they did not see any signs that the Supreme Leader, the Ayatollah, had once again authorized the resumption of a nuclear weapon that was put on hold back in 2003. And so both the decision and the justification are going to be key from here onwards.
Yeah, that's really important, isn't it, in terms of the justification and how the US would frame this, if indeed that is the decision they take. Meanwhile, Jumana, I know you've been watching this very closely as well in terms of the attacks between both sides. Is there any sign at all of de-escalation between Iran and Israel at this point?
We are now in a sixth day of conflict. The strikes have continued overnight. Israel continues to target some key sites, air defense sites specifically around Tehran. More evacuation notices have been issued. This morning, they announced that they hit a centrifuge site. In return, Israel has also said that they have intercepted more missiles and drones being launched from the Iranian side, albeit at a slower intensity than the first couple of days of the attacks and the counterattacks. In terms of language, the Israeli Prime Minister has reiterated that he will continue to strike at all sites associated with the Iranian regime. And we heard from the Ayatollah himself. He put up a tweet overnight on X saying that they will show no mercy. We also know that the U.S. Embassy in Jerusalem is closed now for 2 more days. So that brings it to 3 days in total. So to answer your question, Tom, no real signs of de-escalation, despite the fact that many Arab states from the region, Gulf states, have been actively looking to mediate and to bring down the temperature.
Okay, Bloomberg's Jumana Basechi in Dubai. Thank you very much indeed for that update. Now, top US bank regulators plan to reduce the key capital buffer by up to 1.5 percentage points for the biggest lenders. That's after concerns that it constrained their trading in the $29 trillion Treasuries market. Let's bring Bloomberg's Valerie Teitel for more. Not unsurprising, but significant nonetheless that this is the proposal. Val, what is the significance?
Well, look, this is all part of perhaps Trump's deregulation push. Now, when it comes to bank capital reform, this plan has really been long in the making. It seems like we get leaks about this constantly, but the Fed is going to be meeting on this next week. So there are hopes that it gets pushed forward, not just with the Fed, but with other regulators. I think the important thing from this is it seems they've not necessarily decided on whether there should be a specific carve out for the Treasury market. There was hopes in order to aid liquidity in this growing Treasury market that Treasuries would be carved out completely from the SLR, meaning that banks wouldn't have to hold a capital against their Treasury holdings. The problem here, Tom, is that the Treasury market has ballooned in size, and what's not ballooned with it is the balance sheet of these banks having to facilitate liquidity. So that's caused an issue, and it caused a hiccup in the Treasury market back in April, and that's something that regulators are looking to address. They say that regulators may ask the public for comments when it comes to Treasury market regulation. That's maybe foreshadowing of not necessarily made a final decision on the Treasury market side.
Okay, to the Fed today then, fully expected to hold again for the fourth straight meeting. So where will you be looking then, Val? What is going to be of interest for the markets?
It's all going to be the nuance in their updated economic projections, both when it comes to their inflation projections and then in the dot plot. Really, what the market is trying to figure out is how many members of the FOMC think that this tariff-induced inflation will be transitory, and how many think that this is going to cause persistent inflation that will maybe bring their cutting cycle to an end earlier than assumed. The market still believes that there'll be around 2 cuts into the remainder of the year, and I guess the base case for today is that we do get a hawkish dot plot, maybe perhaps toning down how many number of cuts, perhaps taking it from 2 from their previous meeting down to 1. But I, for one, would be looking at the number of FOMC members who are penciling in no cuts. And if that number continues to grow, to me, I think that's going to reflect maybe the consensus on whether this tariff-induced inflation is going to cause persistent inflation. I think that's going to be telling in the dot plot.
Okay, Valerie Teitel, thank you very much indeed. And what to think about as we lead up, of course, to the Fed's decision and the press conference from Jay Powell that we, of course, will be bringing to you live. Let's get more analysis right now on these markets with a lens also on the Fed with Ursula Marchioni, EMEA Head of Investment and Portfolio Solutions at BlackRock. Ursula, thank you so much for coming into the studio. So we start on the Fed. You and the team, expecting 2 cuts this year from the Fed. Is that right? What has to come together to get the Fed off the sidelines and bring through 2 cuts by the end of the year?
It's a great question. Thanks for having me, first of all. So, agreed with the view that it's going to be a hold today and the dot plot will be in focus. The Fed has been wrestling with the delta between soft data and hard data for a while now. And so soft data points to sentiment weakening. Hard data thus far, if we think about CPI last week, have been holding up quite well. Yet overnight, yesterday, we saw retail sales, for example, coming in weaker than expected. And so I think there is this element around how is this gap and delta going to close up? Which one of the 2 sides is going to go towards the other? That will be a big North Star, I believe, for the Fed. Now, interestingly, going back to geopolitical tensions that we are observing and news overnight, thus far we have seen the conflict in the Middle East having a relatively contained impact on markets. If you look at, Brent crude, 76, still below the average last year. Yet, if we were to see an escalation and, for example, Iran production were to get hit or the Strait of Hormuz were to be closed, I think that is where you would start to see a transmission mechanism unlocking towards further inflationary pressure and potential impact on growth. And I think that will be in the back of their mind of the Fed later today as well.
The estimates obviously are variable in terms of what the closure of the Straits of Hormuz, if that was an option that Iran went for, would do to oil prices. But some suggesting you're looking at $125 a barrel on oil. You're looking then for hedges around the inflation story. Where does that take you?
Exactly. So I agree with you. There's like 3 big themes that I observe being priorities for investors at the moment. One is diversification and hedges, which take multiple components. I'll start with gold. Gold has been obviously, the big beneficiary of both the tariff-induced volatility, but also the geopolitical risk increase that we've observed. And it has done a lot. At the same time, I was with some large Swiss investors last week, and they told me for the first time that gold in their clients' portfolios has moved up from 2-3% historical allocations to now 5-7%. So you see the institutional and wealth investor money coming and continuing to come into the exposure. And we've seen that this year. We've seen 32 billion flowing into gold exchange traded products year to date, vis-a-vis, at this point last year, only
But has the window closed on gold? Because Citi is forecasting gold gets down to 2,700 per troy ounce by next year on rate cuts, on slowing growth.
It's a good question, Tom. So I think that search for diversification from investors at portfolio level will continue, and that will provide support. And then we're reading that central banks are also changing their allocations towards gold, which has now overtaken the euro as reserve currency in their allocations. So I think there's still space there for adoption. I would also flag gold miners as a laggards that can provide exposure to that protection. In general, in terms of broader portfolio themes, market-neutral strategies, systematic strategies are becoming more in favor for investors, again, as a way to protect and defend portfolios. I'm seeing that theme also spilling over into equities. So if I think about US equities there as well, it's difficult to avoid the US in terms of corporate resilience, corporate strength, earnings. You still go there. At the same time, it's important to do so with defense, thinking about minimum volatility strategies or, opportunities to buy on deep into high conviction trades. We mentioned earlier, financials, bank potentially benefiting from further regulatory loosening, or AI being the other one.
When we talk about inflation, we think as well about the BOE. That decision is tomorrow, but the inflation risks on higher oil posing arguably a challenge for the Bank of England. Given the inflation data that came out of the UK today, higher than estimated, the highest level since for this year, 3.4% on CPI. Is the risk to more dovish rhetoric from the BOE and that tilt to a more dovish BOE, does that still hold up in face of the oil risks and in light of the inflation data we have today?
I agree with you. It doesn't make it easy for the BOE because the inflationary component has been already there, and what we are observing at geopolitical global level further adds to those concerns. We expect a hold as well and a continuation of the quarterly pace going into August and then November. But you're right that among the central banks, the BOE has one of the most interesting conundrums to balance out.
Where are you finding opportunities in the gilt market? I mean, we're weighing up slightly softer data. We're weighing up where the BOE goes. Are gilts offering a premium that is looking attractive at this point?
It still does, and it's a great question in terms of locking in income, which has been a big theme in fixed income overall. So if I look at May, we've seen the highest adoption of fixed income ETFs, second highest on record. So you can see investors coming into the asset class with conviction. And arguably, if I look, for example, at European credit, it isn't cheap. But every time spreads widen, you see this pool of money coming in. I think gilts are an area where this idea of locking in income also comes through and still remains an opportunity for investors.
Bank of America, their fund manager survey, and the results suggest that there is a view that global stocks outperform US stocks over the next 5 years. We've clearly seen that outperformance of European stocks versus their US counterparts this year. It's not something that's happened very often in the last decade or so. Do you align with that view? What are the flows showing you in terms of that appetite for European stocks and global stocks over their US counterparts?
Yeah, the flows have been remarkable year to date. So just to put things into perspective, if I look at where we were in 2024 last year, we would have seen 12 billion going into European equities. Year to date now, 60 billion, so 5 times what we observed.
12 billion versus 60 billion.
Exactly. And this is at global level. Of that 60, 45 billion coming from European investors. So to your point, entering and coming back to the market and funding the positions from US equities. Last year, at this point, European investors would have bought 27 billion, year to date now 10. So you can see that rotation really unfolding. Look, I think Europe is still very much a selectivity story in terms of acknowledging this repatriation trade. There are elements there around the importance of selection, which you can capture through active strategies, or you can capture by looking at sectors such as banks, which we continue to favor, or defense. I was looking at the underlying index of one of the ETFs that we recently launched. It has done 100% year to date, and yet speaking with our analysts in the fundamental equity team, they tell us that the sales growth for the sector are expected to grow ×4, ×5 over the next 3 years. And so again, you see that trend not having finished. So again, Europe, there's money in motion significantly. Selectivity is the way forward, and defense is a good area to continue.
Okay, that's really nicely summed up. The flow show continues into Europe, but be selective. Ursula, thank you very much indeed, with views, of course, on the Fed and the BOE as well. Ursula Marchioni, EMEA's head of investment and portfolio solutions at BlackRock. Coming up, we're going to talk Fed and dollar with a focus this time on FX. We're going to bring in Elsa Linos, global head of FX strategy at RBC Capital Markets. Well, longer term, still has a view on weak dollar. We'll unpack that next. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome back. Fed officials widely expected to leave interest rates unchanged for a 4th straight meeting later today, with President Trump's trade policies adding, of course, to uncertainty around the economic outlook. But they may telegraph their intentions via revised forecasts or the dot plots. We're joined now by Elsa Linos, Global Head of FX Strategy at RBC Capital Markets. Elsa, thank you for joining us in this studio. We were just talking to Ursula Marchioni from BlackRock. Their view at BlackRock that you still get 2 rate cuts from the Fed by the end of this year. Do you align with that view? What pulls the Fed off the sidelines?
That's the RBC view as well. The risks, of course, are skewed towards a later start, but if they do start later, they may have to go a bit faster into 2026. So I think the end point stays reasonably the same, around 150 basis points of cut through the middle of next year.
Okay, 150 basis points of cut through the middle of next year. What today are you going to be scrutinising? It's one of those meetings, again, where we're expecting a hold. So it's the press conference, it's the updates around inflation, around jobless, and the dot plots. What for you is going to draw your eye?
I mean, the reality is there are a lot of expectations baked into this meeting, particularly after the last meeting was such a non-event. Powell very much in wait-and-see mode, and as our head of rate strategy put it, this is going to be wait-and-see with some dots. At the same time, if there is a risk that the tone shifts, it may be towards the more dovish side. We have seen some softening in the labor data. We've certainly seen some downside surprises in CPI. Offsetting that, there's still the uncertainty both around tariffs and around events in the Middle East and the pressure it puts on oil prices. And so I think all things considered, we expect the Fed to remain on hold with 2 dots for the rest of the year.
Okay, still 2 dots for the rest of the year. Okay, so we'll watch those forecasts and see if that aligns with your view. Bloomberg reporting today as well, and looking at some of the pricing in the options markets around 2026, and particularly after Jay Powell steps down in May of next year, and ramping up bets that essentially get a more dovish head of the Fed. Is that the right way to be thinking about it, given the pressure that President Trump is putting on the Fed at this point?
Yeah, the president has put a lot of pressure on the Fed, but at the same time, I think very much depends who you get stepping into the seat of chair, how widely respected they are by the rest of the board, and also, frankly, what the economic reality is on the ground. I mean, the truth is that we are seeing that softening starting to creep into the data. Retail sales yesterday, not fantastic. You know, household consumption has been held up by higher incomes, effectively spending their way through any slowdown. That may also start coming off. So I think as we go into 2026, it is reasonable to expect that we are going to be seeing rate cuts from the Fed.
I want to quote from your notes to us. This on the dollar. In the long term, we maintain our conviction that the dollar is on a structural path lower. Just unpack that for us.
Sure, there's a lot of factors playing into this, and there are some structural but also some cyclical factors as well. If I start with the cyclical, you know, we went into this year with a strong belief in US exceptionalism baked in. Now, that's not to say US exceptionalism is completely dead in the water. The US still has stronger productivity growth than a lot of other places in the rest of the world. But at the same time, what we're seeing is a convergence between US growth and the rest of the world. We've seen the upward revision in European expectations, downward revision to the US. And so that naturally is going to lead to a convergence, we think, in terms of front-end interest rates as well. In turn, that will drive the cost of hedging, which we think is really impactful both for euro-dollar and for dollar-yen, and that underlies our forecast for 120 in dollar-yen by the end of next year, 124 in euro-dollar. On the structural side, there has been a very long-term allocation or overweight allocation to US assets. You touched on it with your previous guest. And we are now beginning to see that reverse to some extent. I mean, it's still early days. We don't want to get ahead of ourselves. And, you know, there's a lot of talk around de-dollarization, but the truth is these are events that take a very, very long time to play out, you know, long-term factors rather than something that happens overnight. But it is true that we are seeing a kind of slow reduction of allocation to US assets and an increase to the rest of the world.
How fundamental is the breakdown in correlation between the dollar and the 10-year yield?
So for me, what's really interesting at the moment is not so much that breakdown, so much as the breakdown between the dollar and certain the dollar against risk proxies and equity markets.
Okay.
And the reason I say that is, you know, take Canada, for example. We focus a lot on Canada being the Royal Bank of Canada. But historically, you would have seen a very strong inverse relationship between dollar CAD and equities. So what that meant is that for Canadian investors holding long US equities, they were kind of naturally hedged by the currency to some extent. Now, as you see that correlation diminish, almost reverse, it actually incentivizes people to start thinking about putting currency hedges on, and that in turn leads to another source of selling pressure for the US dollar.
The yen, I mean, you just mentioned there, you see further upside for the Japanese currency. What assumptions are you making about BOJ's moves above 0.5% right now on their benchmark rate? How far do they take it, and how much of that is going to be supportive to the yen? How much are you assuming in terms of where the BOJ goes?
It's a good question. I think realistically more of the convergence is going to come from the Fed cutting rates rather than the BOJ necessarily hiking. And I think if you look at the hedging behavior of lifers, they do tend to follow the cost of hedging fairly closely. So we've already seen an increase in hedge ratios since October of last year through to April, May, when we got the latest semi-annual investment plans, an increase of about 5 percentage points. That has a lot more room to run. So if the cost really does come down materially over the next year, those hedge ratios could raise by another 20-25 percentage points.
Okay, Elsa, fantastic breakdown of the FX space. We didn't get time for the pound, but next time. Elsa, thank you very much indeed. Elsa Linos, Global Head of FX Strategy at RBC Capital Markets, with that longer-term view as well on the cyclical factors and structural factors around the greenback. Coming up, oil markets continue to swing, of course, as Middle East tensions build. We get a take on the commodity markets next. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good, but as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Good morning. Welcome to The Pulse. I'm Tom McKenzie in London. These are your top stories. Speculation grows that the US may join Israel's attack on Iran as President Trump met with his national security team after calling for Iran's, quote, unconditional surrender. In markets, oil hovers near a 5-month high on the escalating Middle East tensions as investors also look ahead to today's Fed rate decision. Plus, Meta's millions, OpenAI's Sam Altman says Mark Zuckerberg has been poaching AI staff with signing on bonuses of as much as $100 million. Let's return to our top story now, though. Of course, Israel and Iran have exchanged fire for a 6th day as speculation grows that the US might increase its involvement in the conflict. Bloomberg understands Donald Trump had a meeting with his national security team yesterday, having earlier called for Iran to surrender. With me now is Ros Mattison, Bloomberg's EMEA news director. And Ros, we've just been seeing some lines crossing from Iran's ambassador to the United Nations. What have we been hearing from Iran's representative?
Well, these comments come after the US President Donald Trump said that he called for Iran's, quote, unconditional surrender. And we saw the Supreme Leader Khamenei last night again say they're going to keep going. And echoing that, we see the comments from the ambassador to the UN speaking in Geneva saying, you know, if the US gets directly involved, and that's like right now what they've been doing is helping Israel repel attacks. If they take on an offensive role in this conflict between Israel and Iran, that Iran will come for US assets in the region, military assets. That's a line that Iran has been saying repeatedly. I mean, they're already saying, they said that the US, they say, is complicit in this conflict already. So there's nothing massively new in that, but another sign again that, you know, there is a risk of this conflict broadening, because if Iran does decide for whatever reason to hit US assets, that's going to bring in a whole lot of other countries potentially in the region. What are Iran's other options at this stage, given what we know, and there's a lot of uncertainty as to Trump's next steps? What are their options? Are we in kind of regime survival mode at this point, or we're not quite there? Well, possibly we are. I mean, a lot depends, obviously, on the US deciding what it wants to do. But from Iran's perspective, you've potentially got a number of options, and one of them is making that choice between preserving their nuclear program or turfing that in order to focus on regime preservation and finding a way to hold on to the regime there. Obviously, they have to manage the messaging on that at home. It's very difficult, but do they make that choice to jettison some of their nuclear program in order to keep the regime intact? Do they decide to try and broaden the conflict? Because, dare I say, if you start striking other assets in the region, you're going to bring in a whole conversation around NATO and collective defence for the US potentially. And do you do that to sort of see if you can really exploit differences between Europe and the US? I mean, it's a very risky gambit, but do they say that they feel they've got no other option? Or do they just hope that somehow, you know, this tapers off a little bit and returns to a semblance of something else for now? Most unlikely, given, you know, the perspective from Israel, but, you know, that's probably some of the conversations that will be happening inside Iran.
What is our understanding of Trump's decision-making process at this point? A president who we understand has aspirations for winning the Nobel Peace Prize, for example. How close are we to President Trump potentially making this momentous decision, and what could the risks be for the US?
Well, the risk could be very significant. We've seen the trajectory of Donald Trump really not wanting to allow or encourage Israel to attack Iran, and then to essentially largely backing the Israeli position. And does that extend to the next bit, which would be the US militarily supporting Israel and saying, at this point, we need to get in there and just try and get this job done on Iran's nuclear facilities once and for all. There's probably a lot of conflict going on within the group around Donald Trump on that. You've got Republicans who say, we shouldn't be getting involved in conflicts overseas. This is not our business to be stepping in militarily. We should be letting Israel get on, but it's not for us to do. To others saying, you know, very much like wanting regime change in Iran and saying you've got to keep pushing on this. So conflicting views in his administration, where does he lean in all of that? And as you say, the risk again is that if you do get directly militarily involved, is that going to prompt some kind of reprisal within the region directly targeting US assets?
Okay, Rosalind Matheson, thank you very much indeed, with an important update, of course, in terms of how this conflict continues to unfold and the next steps for the US president and his team, of course, in terms of their involvement. Now, Italian Premier Giorgia Meloni, meanwhile, is pushing G7 leaders to support a ceasefire in Gaza amid the escalation of hostilities between Iran and Israel. Meloni says she's found agreement with many of the leaders that she's spoken to in recent days. Meanwhile, worth reminding our audience that in Gaza, the city's health ministry says at least 51 Palestinians were killed and more than 200 wounded in an incident while waiting for aid trucks. The Israeli military acknowledged several casualties after they opened fire on a crowd and said authorities would investigate the incident. US President Donald Trump has resisted, meanwhile, G7 calls to impose new sanctions on Russia, despite urging a ceasefire in Ukraine. However, Canadian Prime Minister Mark Carney unveiled new measures to support Ukraine, including $1.5 billion in military support.
The importance of using maximum pressure against Russia, who has refused to come to the table. The president has led unconditionally to come to the table in search of peace. And maximum pressure includes financial pressure.
Let's bring in Oliver Crook from Berlin, who's following this for us. So G7 leaders, they couldn't convince Trump ultimately, Ollie, to impose tougher sanctions on Russia. What were the sticking points for the US? What held them back?
Yeah, so there are two really avenues by which the United States could help exert some more pressure on Russia from the European perspective. One would be for the U.S. to join in on this idea from the EU and the UK, who came to the G7 hoping they could get Trump on board to basically lower the oil price cap that currently exists on Russian crude that's being sold across the world from $60 down to $45. That is something that the Europeans, I think, quite optimistically wanted to get Trump on board for, and obviously the U.S. administration doesn't really like to follow anybody in terms of their policy going across the world. Trump likes to set policy and have others sort of follow behind them. What we got instead, of course, is the Trump administration. The other sort of side of it is the secondary sanctions that Lindsey Graham has prepared from the U.S. side that the Trump administration and Trump himself does not really seem very convinced by, right? There is bipartisan support in the Congress for the United States to move forward on this, but Trump is still basically not convinced. And he spoke most recently with Vladimir Putin on Saturday on Trump's birthday, you know, talking about Iran among a number of other issues, but really really, I think the fear for the Ukrainians is that this becomes, as the Iranian sort of conflict begins to expand and continues to expand, comes further and further to the back burner, and as a consequence, the Ukrainians basically fall short and become sort of forgotten as basically the rest of the world is dominated by all of these other issues that are going on. And of course, the Europeans wanted to get Trump further on side with Russia. This is the thing they've been trying to do for months and months and months and failing to do so. And what Trump ended up saying was that basically the G7 were to blame for the war in Ukraine because it was because of the G7 that expelled Russia from the G8 that Russia invaded Ukraine. Of course, we remind everybody that the reason that Russia was expelled from the G8 was because of their initial annexation of Crimea back in 2014.
Yeah, and that's an important reminder, isn't it? So Carney stepping up, the Canadians stepping up with more support for Ukraine, even as Trump remains on the sidelines. Ollie, is this how it goes from here, that individual nations, whether it's Canada, the UK, the French, the Germans, individual support for Ukraine, and is that going to be enough to tie Ukraine over?
So listen, Tom, let's think about how this aid has basically been structured over the last 3 or so years that this war has been going on. It has been U.S.-led. U.S. has done the majority of the deliveries in terms of the military hardware. The EU has put up a lot of money, but it has really been anchored in the United States and its military equipment. What we had was the last package from Joe Biden. We understand from the sort of information that we have that that will basically expire by the sort of end of the summer. That leaves a huge hole for the Ukrainians, and that is a hole that will increasingly have to be filled by individual nations and the EU. And going toward that end, Mark Carney stepped up over the last couple of days and put forward that $1.5 billion worth of military aid to Ukraine. He also boosted sanctions on the Russian shadow fleet. This is one of the main arteries by which the Russians are still financing the war, and he's called basically for maximum pressure. The problem is that the EU and the sort of G7 x the United States, they're limited in what they can do. They've basically come close to maxing out what they can do on sanctions. There are a few other things they can do, but really the U.S. holds the chips on that. Even with Russian gas, the EU has been talking about finding a way to basically ban Russian gas from their systems by 2028. They do not have consensus within Europe to do that. So again, as we see these things escalating, there's not consensus within the Europeans. For the Ukrainians, the key question is going to be who is going to be able to step up. The Germans have stepped forward. The Canadians have stepped forward. We'll see how much further support they can give over the coming months.
Okay, Bloomberg's Oliver Crook in Berlin. Thank you very much indeed with the update in terms of the support or lack thereof for Ukraine as it continues to face pressure, of course, along its front lines from Russian forces. Now, oil continuing to fluctuate after rallying some 10% since Israel started its attacks on Iran last week. Joining us now is Ole Sloth Hansen, Head of Commodity Strategy at Saxo Bank. Ole, thank you for your time and thank you for waiting patiently in the wings as well. So we're seeing fluctuation around the oil price today. Brent is down 0.5%. WTI is at $74 a barrel, also a little softer by 0.4. There is this volatility in the oil markets. How much of a risk premium is priced in at this point?
Well, good morning, Tom. Quite a bit, I would say, considering that if we disregard the current turmoil, Brent crude prices should probably trade below $70 given the fundamental outlook as we have it right now. So there is a premium in. And obviously, what is the concern in the market is that premium could explode even further if we have an actual blockade of shipments coming from the region, especially through the Strait of Hormuz. And I think that's really, so we're basically facing a binary option here where we could see prices sharply higher or sharply lower. And with that in mind, we're seeing quite a lot of the activity being concentrated in the options market simply because the fundamentals does not support higher prices, but again, the risk does. So with that, we're seeing calls being priced quite significantly over puts right now.
Okay, so there is that binary direction for oil prices depending on how this story in reality, of course, unfolds. What is the potential upside for oil, Ole, on and in a situation where Iran does go for that chokehold on the Straits of Hormuz?
Well, it's I would say it's anyone's guess because there is obviously inventory levels around the world, especially in China, that could be put to work initially to mitigate some of the upward pressure. But as we saw that 13% spike on Friday, just the risk of something happening, and so the market is very spiky, and the risk of a further move higher is obviously there. So the move, if we are seeing 20% of the world's supply being locked in for a period of time, then obviously we will see prices move above 100 to a level where we start to have a negative impact on demand in order to balance the market.
Is there a demand destruction story at this point, given the geopolitical risk, given the uncertainty, given some of the weaker data out of the US and China that's still not firing on all cylinders?
I wouldn't say so. We've kind of come accustomed to this kind of range. We're a little bit above the range that we saw earlier this year, but not to the extent that it's having a profound impact. Also, we have to remember this was happening probably at the worst possible time for crude oil, simply because it was on the rise, because we are going through a strong period of summer demand, as we always are, driving more, flying more, and using more energy towards cooling. So it hit the market at a time where demand was already strong, before the expectations were for pointing towards slower and easing demand into the autumn months, which then could add downward pressure. So I was thinking at this point in time, even though refinery margins are moving higher, diesel costs in Europe is quite a bit higher than the last week, but still probably not enough to have an impact on demand.
Does any of this, given the known unknowns, does any of this change the calculus, do you think, of OPEC Plus?
Only that they're still needed as the regulator of supply and demand. They have been adding supply for months now, and then that has not really had a negative impact on price. And now we can see that it was needed, but it's difficult to say. We need to get on the other side of this to see whether the unity can be maintained, because there's no doubt that the OPEC Plus is run by a few countries, and while the others try to follow suit. So we'll see when we get past this.
Ale, I want to get your views. You touched on China. The IEA came out earlier this week with a report suggesting that they were bringing forward their forecast as to when we get to peak oil demand, with China really kind of in focus within that report. Does that ring true to you in terms of peak oil demand?
I think it does, considering the phenomenal rollout that we're seeing right now in China towards electrification. They're really leading that charge, and if that continues, then we will see an eventual rollover of demands starting to taper off. And then the question is really what kind of strength we'll see from other still growing energy consuming nations like India, and then eventually we'll see what kind of impact it has on the overall level of global demand. But we are getting close to that point where the focus in the market will probably be less on China and more on some of the other growth countries.
Okay, that's really interesting. The demand focus switches from a China that electrifies maybe to some other larger consumers within the emerging markets. Gold currently, I want to get your views on the yellow metal. Gold a little softer in the session, just down a tenth of a percent. Of course, it's had that pretty startling run-up year to date for the yellow metal. Currently at 3,384 per troy ounce. What is your view in terms of where gold goes from here? How much is priced in? Citi coming out with a view and a forecast that the gold basically is as good as it gets right now, and it's heading towards 2,500, 2,700 maybe by around the middle of 2026.
That would be an obvious answer to a market that has rallied as hard as it has now for a while. But we have to remember that a lot of the reason for this rally is basically central banks taking gold out of the market, putting them into vaults where it's probably going to stay for a long time, and that's tightening the market and moving metals away from the market. And at the same time, we actually have quite a recent low investor demand if you look at futures and ETFs. So that could still spring to life if we see the funding costs come down further. And then so I think in the short term, the focus is really on the direction of U.S. interest rates. I believe that gold is looking tired. There's no doubt about that. We're going through a period of consolidation here. It could potentially fall further. I'm not concerned as long as it stays above 2,900. And in the meantime, we're seeing some of the smaller metals being allowed to shine. So we're seeing a phenomenal run-up recently in both platinum and silver. And then obviously they don't have the same problem as gold. They're still quite far away from their previous record highs. So that basically makes it a little bit of an easier investment decision for some at this point in time. But I think going forward, gold needs lower funding costs, lower interest rates in the US for it to push back up towards 3,500 and beyond.
I say, to be clear, there's a catch-up trade when it comes to silver.
There is indeed. The silver is, as I always say, silver is gold on steroids. It tends to move faster in both directions. We had that significant slump during the Liberation Day panic back in April, and since then it's slowly recovered. Right now it's trading around 91 ounces of silver to 1 ounce of gold. That hit a peak above 105, but the long-term average is closer to 80. So just based on that, return towards the average price could see it outperform further. So I think the market now, having moved above 35, having moved above 37 yesterday to a fresh 12-year high, then obviously 40 will become the next psychological level that the market will be talking about. So we'll see now. We just need to gain a foothold above 37 to see whether we can actually make a push towards that level.
Okay. Ole Sloth Hansen, Head of Commodity Strategy at Saxo Bank. Gold looking a little tired. Silver is gold on steroids. Appreciate the insights into this commodity space. Thank you. Coming up, we're going to switch focus because OpenAI's Sam Altman says Meta has been offering signing bonuses, get this, of as much as $100 million to poach top staff. We all should have worked harder on maths. More on the increasingly expensive AI talent race. That is up next. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Today, the Fed decides.
You can't set policy because you don't know what policy is going to be.
The Fed is codependent on the president.
They're worried about stagflationary shock.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
We're going to be watching the data.
The policy tool that is communication is now filibustering.
The economy could go either way. They're watching like we are.
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern.
Welcome back. So the Federal Reserve, of course, is expected to leave interest rates unchanged for a fourth straight meeting later today, much to Trump's ire, no doubt. This as Fed officials continue to weigh the impact of the president's trade policies on the economy. For more, let's bring in Bloomberg M9 strategist Ven Ram on what to watch then from the press conference and the updates around the forecast. We've had two guests on, Ven, so far on the show, one from BlackRock, one from RBC Capital Markets. Both see dot plots pointing to an additional 2 cuts, or at least 2 cuts in 2025, so reaffirming the market views. Do you align with that, or do they adjust the dot plots lower?
Hi, Tom. Good to be talking to you. Yes, I'm very much aligned with what your guests have said. I think two rate cuts is what the Fed is going to prepare the markets for, because if you look at the March dot plot, Tom, I mean, they already slashed the growth rate from 2.1% to 1.7%. So I don't expect too much of a revision on that front, because if you look at the Fed Atlanta GDP, it's pointing to a robust expansion in the second quarter. So I think they are going to be pretty comfortable with that 1.7% forecast. If you look at core PCE, yes, it's trending lower, and they will probably pencil in a slightly lower number, albeit I think they will stay with 2 rate cuts, because they probably do not want the markets to get ahead of themselves, especially in a scenario where there's still too much uncertainty about policy, and there's uncertainty about how the tariffs are going to impact inflation down the line. With that known unknown still weighing on the Fed's minds, they are unlikely to be throwing caution to the winds and indicate more than 2 rate cuts. So I think 2 rate cuts is what we are going to get, and that's what the markets are going to take away. And that means that the front end is going to be pretty anchored around 4%.
Okay, so the front end anchored around 4%, two cuts likely to be signalled by those forecasts, by those dot plots. To the UK then, I know you keep an eye as well on the data out of the UK and how that ties into thinking around the BOE, which of course steps up with their decision tomorrow. So higher inflation data out today, higher than estimated at least. To what extent does that tie into the BOE's thinking? Do we get a more hawkish BOE than maybe some had suggested?
Yeah, I think that the BOE is likely to be more cautious going forward. Look, we got what did the inflation report today show us? It showed us that core inflation is bobbing around 3.5%, retail inflation around 4%, and services inflation is closer to 5%. None of those numbers are telegraphing any confidence to the market that a 2% inflation target is likely to be attained anytime soon. And if you look at crude prices in the past, this month, they have surged about 20%. So the BOE, the UK economy is particularly vulnerable to imported energy inflation, and therefore the BOE is likely to turn more cautious. We already had Pill saying last month that, look, he's doubting the speed at which the BOE is going, i.e. the BOE is going at once a quarter pace, and the Pill thinks that even that is too fast. So I think that the BOE has all the incentive to turn more cautious tomorrow. Of course, nobody is expecting any action. So I think that the markets are thinking that the terminal rate is going to be around 350. I think that the terminal rate is more likely to be around 375 or 4.
Okay, Venram, thank you very much indeed from Bloomberg M Live with a look ahead to both the Fed and the BOE, folding in that inflation data out of the UK that came in slightly higher than expected. Ren, thank you. Now to the UBS story. This is pretty fascinating. UBS says a cyber attack and an external supplier has led to information about the Swiss bank and several other companies being stolen. But UBS says, this is also important, of course, that no client data has been affected. Information on more than 130,000 employees has reportedly been published on the dark net. That is according to Swiss newspaper Le Temps. The data set includes the direct phone number of CEO Sergio Ermotti. Now, on tech, OpenAI Sam Altman says that competitor Meta has offered some of his staff signing bonuses of as much as $100 million as the race for AI talent ramps up. Charlie Wells is here with the latest $100 million bonuses. Charlie, what on earth is going on?
And those are only signing bonuses. That does not even include the
That's
annual,
just a signing bonus?
Yeah, that does not even include the annual compensation, at least according to what Altman said on a podcast with his brother. Meta has not responded to comment there. This is, of course, a sign of that talent race heating up in the AI space. And we're going to hear a lot of noise, I think, about this today. But there is another issue to focus on here, which I think is interesting, which is a lot of these big tech firms have learned about the threat of antitrust. And at this stage in the process of the development of this technology, they may be concerned about acquiring full firms. So instead, what some of this strategy seems to be is you make an investment in a startup, and then you poach talent and bring it into the fold at your much larger tech firm because of that looming issue that so many of these firms have about antitrust. So I think this is what this gets at, this huge race for talent, but also this concern about acquisitions.
Charlie Wells, thank you very much indeed. Plenty more coming up. Bloomberg Brief is up. This is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
We're micro investors. So as micro investors looking to invest capital, whether it's in private equity or in direct lending, what we're looking for are opportunities to deploy capital at attractive risk return. When we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. Now, in our existing companies, in our existing portfolio, the vast majority are services companies. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich, it's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself. But in our portfolio companies, we roll up this data every month. For example, the inventory component of PMI was up about 4 points. I know that's not really news that anybody probably would have focused on, but we could see that happening months ago. So immediately when it looked like the new administration was going to come in and there was the possibility of tariffs, you could see purchasing managers immediately mobilizing to start bringing goods in faster because of the uncertainty factor.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Wednesday morning. Day 6, the conflict between Israel and Iran continues as speculation of U.S. intervention grows. It's Decision Jay Powell on deck as regulators attempt to ease strain in the bond market. And a hiring spree. OpenAI says that Meta is trying to lure its employees away with an $100 million bonus. It is escalation that is the fear of this market. At least it was of yesterday, with President Trump putting on Truth Social, calling for total surrender of Iran. More U.S. military assets moving to the region. You got a sell-off yesterday, a slight one, less than 1% for the index. That turns into some gains this morning. Your S&P futures session up 1/3%, about the same for the NASDAQ 100 futures as well. For the Brent crude, that also reached its highest since February yesterday. We ease off of that to a large extent. We're down 1.4%. It was high at 7% at some points yesterday, so it's not a complete undoing of that. Still some nerves in this market, but with no developments overnight, we take a breather. Bonds, little change this morning. We head into a Fed rate decision, so we wait on the sidelines for that. Let's get you some stocks to watch this morning. With that is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So UBS shares taking another hit this morning as a Swiss lender gets its 5th downgrade in just a few weeks for the stock. We're now seeing UBS cut over at Morgan Stanley. They're going underweight due to the update from the Swiss government on the capital outlook. Remember, the Swiss government telling the bank they need to hold around $20 billion worth of cash on their books following the takeover of Credit Suisse. That one coming down, Morgan Stanley coming more bearish on there. Then we've got Airbus following the backdrop of the Paris Air Show this week. Airbus increasing its dividend target, saying they're going to pay out around 50% of their profit in dividends if they manage to sell as many planes as expected. So Airbus gaining around 3% in Paris. And then finally, Peloton rebounding following that massive drop yesterday that followed news that the Senate is not looking to include health savings accounts in your allowances for buying pelotons and also your gym memberships as well. So that took a big drop yesterday, coming up slightly today. And as usual, check out the Before the Bell opening wrap for a fantastic roundup of all of these and more on the Bloomberg Terminal, Danny.
We will definitely do just that, Joe. Thank you very much. We'll catch up with you later in the hour. Also, in this hour, in just moments, we'll be speaking to SocGen's Kit Jukes on his euro-dollar call. And later in the hour, we're going to be drum beating to the Fed decision with Citi's Andrew Hollenhorst. Now, Kit seeing a ceiling to a higher euro-dollar, writing, quote, "We expect the euro-dollar to trend higher over time, reaching 120 by early 2025, but we don't think it has much more upside than that. The U.S. economy is softening, but so far there's nothing to encourage overly gloomy U.S. growth forecasts or hopes of aggressive Fed easing." Joining us now is Kit Jukes, Chief FX Strategist at SocGen. Kit, that might be 2026, I take it, since we're already past the early stages of 2025. But even so, Kit, we are seeing some perkiness in the dollar and slight as the geopolitical conflict unfolds in Iran with Israel. To what extent does theory about this economy, about the U.S., give way to instinct in haven buying for the dollar?
Oh, it can do at any point in time. I mean, there's a lot of uncertainties around it. Look, for me, there's a couple of things. Firstly, in terms of euro-dollar, there's a European side to this, which is that the decision to roll back the debt brake to some degree is a big move. Euro-dollar was around about 150 when we saw the decision to put the debt brake on when it was first announced. So we're a lot weaker than that. So the fiscal monetary policy mix in Europe is changing, and I think that's reflected in higher bond yields, and that's important. So that side of it is a bit more in the background. I think, though, it's related to the really big issue, which is that I think we've had an awakening this year of the fact that the global investor community is very overweight U.S. bonds and U.S. equities, that foreigners at the end of last year owned $62 trillion worth of U.S. assets. That's a wacky big number. Some of it on the equity side is due to the valuations of U.S. equities going higher. And I can divide our clients into two groups: the ones who think there's no alternative but to go and buy U.S. equities, which is equity investors, and the ones who think that the bond yields that are available elsewhere are now more attractive, safer. For example, you give up, 15 basis points to have a 10-year Australian bond and a debt-to-GDP ratio that's 1/3 of the United States. So you divide it out like that, but I think there's this. I've had a sense for the last few weeks that the market has become, if you like, inclined to hedge dollars or sell dollars on any rally that it gets. And we've held up near that kind of 115, 116 level that we reached initially. We've held up there. So I think we're going to make another push up to 120. We're not going back to pre-financial crisis levels. The European potential growth rate's way too low for that. But I think we can get to a 120 world.
Kit, to the point of we were way overweight the U.S. coming into this year, the latest Bank of America investor survey showed that they are most underweight, most short the dollar, underweight the dollar in 20 years, 31% underweight. They're calling it the most contrarian trade. Has positioning completely flipped? Is it now to the other side?
So I think the investor position in terms of global investors owning U.S. assets is still very high. We still, as the saving nations of the world, have too much of the biggest borrowers' investments because we're lined up that way, and they're uncomfortable about it. I think in the foreign exchange market, whether we look at the weekly CFTC data on short-term positioning or whether we look at some of the surveys, you're absolutely right. We are in way over our skis. Short U.S. dollars, and that's a problem. I thought that was going to be a problem that was going to keep euro-dollar, from invulnerable over the course of the next few weeks. I don't really understand why it's as weak as it is today, with all these people holding onto these positions amid massive geopolitical tensions. So I'm uncertain as to how this plays out. I think, though, the biggest flow is this one of hedging long-term investments in dollars that are underhedged in the equity and bond market.
Does that create this risk then, Kit, of a dollar doom loop? This idea that the dollar starts to fall, so if you're a foreign investor, you're looking at losses on your U.S. assets, therefore you're less likely to invest in the U.S., therefore the dollar starts to weaken, and on and on and on. To what degree is that a real risk for the market?
Well, I mean, I started doing this in 1984. The dollar peaked in February 1985 in the Reagan years, and by 1987, in the second half of 1987. It had given back all of the last few years' rallies. I mean, an enormous rally it had, completely unwound. The US economy was growing at 3% per annum. I mean, there's lots of things going on. And I look at that period and look back and say, well, that is what, if you like, a doom loop looks like. Everybody had been long dollars. It went up far higher than they thought. And then when it started going down, it just went down on its own momentum, like a stone that gathers no moss. Yes, it's possible. I think it's unlikely. I think, I shall be interested to see how this plays out. What I think is more likely is that there will be continuously a belief that if you want high returns in global equities in particular, you're going to have some American AI stocks somewhere in there. Because if they have to pay £100 million $100 million sign-on bonuses for people, it's because it's going to be a great industry. So I don't think the dollar's going to go further. I am not going to put a 130, 140, let alone a 150 euro-dollar forecast down on a piece of paper unless I see this dismantling of just the positions driving everything, or a crushing recession in the United States. Neither of those seems to me like a central case. But I've had to wait 40 years to see how a really big dollar rally unwinds. So here's my second go.
Hey, Kit, careful. You're about to get a call from Mark Zuckerberg asking to poach you away from SocGen 2 with that $100 million bonus if you keep making good calls like this. Look, it's this moment where part of the narrative also, to your point, is how do you outperform without U.S. assets, without AI? To that point, Christine Lagarde, writing in the FT yesterday, saying that this is the moment for the global euro, that its time has come. How much credence do you give, and this is something she's been saying for some time, how much credence do you give to her push to have the euro replace something like the dollar in its part in the global FX world?
It can do so up to a point, but one of the reasons, but there are lots of reasons the dollar's dominant. I mean, it's a very strong economy, and it's got very dynamic economy, and it's a very much less regulated economy. So it's got lots of advantages to it. But that's not to stop the fact that German investors might find they get, Bund yields are attractive, or more particularly BTP yields are attractive at these prices. But it's difficult to become a dominant currency if you're running a big current account surplus, and that's part of Europe's problem. One of the reasons that we all need dollars is that, frankly, they need our money. The US undersaves, overinvests, gets growth from it, and it does it by borrowing money or encouraging foreigners to come and invest in the United States. Now, you could create a catastrophe if a US administration really went out of its way to scare the global investor community out of the US dollar. That's not inconceivable. It would be a huge mistake, so I'm going to assume it won't happen. And otherwise, it's the world's biggest economy, the world's most strongest economy, the world's the most dynamic economy, and the one that needs all of our money to keep it going. So I suspect the flow is still across the Pacific from Asia to the US, across the Atlantic from us to the US as well.
Kit, is there a risk that this is a market, just because we've been trading in really tight ranges as of late, that we've kind of gone on autopilot from something that's like don't fight the Fed to don't fight the Donald, that we assume that it's protectionism, deregulation, fiscal stimulus, that these are the drivers, and we kind of just go from there, that we stop thinking about the evolution of where this economy is going, and we just look to fiscal policy. We look to the White House. Is there a risk that we're on autopilot right now?
I don't know if we're on autopilot when we just look at this vast array of massive risks and try to figure them out. It doesn't feel autopilot. It feels more chaotic than that. But we're trying to look at the political environment and guess it. What I think we're doing is just reacting minute by minute to news bombs that go both ways. The financial crisis felt to me like a series of dominoes falling one after another in the same direction. This feels much more chaotic in terms of news flow. So today I understand where the news flow is going on the situation with Iran, but tomorrow I'll get a piece of news that I just can't say, what? That came out? And so I think we're just jumping around, and that's in the current, just in the last few weeks, that's tied us into narrower ranges, because we're just looking at things in both bonds and equities and currencies. We're not sure what the next piece of news is going to be. So, I'm certainly not complacent. More kind of slightly sort of what? Kind of amazed look on our faces.
It's like the deer in the headlights, but also a fire hose of information. So somehow those two metaphors coming together to leave us frozen. Kit, so wonderful to get your thoughts this morning. Thank you so much for joining. That is Kit Jukes of SocGen. Let's get you some other top stories trending on the terminal this morning. U.S. bank regulators are looking to ease a capital rule that limits banks' treasury holdings. The proposal would reduce capital buffers up to 1.5 percentage points. The plan is expected to be put out for public comment. Representatives from the Fed, FDIC, the Office of the Comptroller of the Currency declined to comment. President Trump is extending the TikTok deadline for a third time. It allows a social media app to keep running in the U.S. while negotiations proceed. The 90-day extension will give the administration time to ensure the deal is closed, which would require an American buyer and China sign-off. And as Kit mentioned, the AI race for talent, OpenAI CEO Sam Altman said Meta is offering its employees a signing bonus of up to $100 million and even larger annual compensation packages. Altman says so far no one has taken Meta up on the offer. Meta did not respond to a request for comment. Coming up, unconditional surrender. That's what the president demanded of Iran. We're going to have more on the conflict in the Middle East. That's next.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Today, the Fed decides.
You can't set policy because you don't know what policy is going to be.
The Fed is codependent on the president.
They're worried about stagflationary shock.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
We're going to be watching the data.
The policy tool that is communication is now filibustering.
The economy could go either way. They're watching like we are.
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern.
No to military actions aimed at regime change, because no one knows what comes next. Haven't we collectively seen the consequences this has had in the region and beyond? Does anyone think what was done in Iraq in 2003 was a good idea? Does anyone think that what was done in Libya last decade was a good idea? No.
The Israel-Iran conflict entering a 6th day. President Trump has weighed in on Washington's options in talks with his national security team. On Truth Social, he called for Iran's unconditional surrender, adding that America's patience was wearing thin. Joining us for more is Bloomberg senior editor for U.S. government and economics, Derek Wallbank. Derek, what do we understand about the U.S.'s involvement up to this point?
Well, Danny, right now the U.S., which has long been Israel's #1 diplomatic weapons supplier and defense partner, has been playing a mainly defensive role. But the key question is whether or not that's going to expand to an offensive role. That's the decision before President Donald Trump right now. And he has said very clearly what he wants out of the situation. He wants Iran to not have a nuclear weapon, not have a pathway to a nuclear weapon, and to give up on its nuclear ambitions. How he gets there is the key question. Does the U.S. get involved in an escalating conflict in the Middle East? Or does Trump figure out that he wants to go into a more negotiated kind of posture, or do we keep proceeding as we're going right now? Really, this is a question that's going to be answered by the American president at some point. He has, as I say, been very clear on where he wants to go, has been very quiet on how he's going to get there. There's also right now a big sort of divide that we see among some of Trump's supporters on the MAGA right in terms of what he should do from here. You know, you do see some people like Tucker Carlson, who Trump has criticized for taking this stance, but say it's not really MAGA to be looking at an escalating involvement in the Middle East. And other sides, you get people like, you know, your Ted Cruz's of the world, your Lindsey Graham's of the world, who have long called for change in Iran and see now as a time to make that happen. So you do get a little bit of divide among Trump's own supporters on how this should go down.
Yeah, Tucker Carlson interviewing Ted Cruz, really hammering him on what he knows about Iran. Derek, we were showing there the Truth Social from the president saying that he knows exactly where the supreme leader is, deciding not to take him out, also calling for unconditional surrender. Derek, do those things suggest that maybe the aim isn't just a change when it comes to nuclear proliferation, but a regime shift?
I think what it signals to me most of all, Danny, is that there is a maximalist pressure being applied by the White House. And we've seen this in a number of other cases, trade being the #1 thing, where the White House comes out and makes a maximalist case for wanting to do something and threatens sort of, you know, kind of apocalyptic or really, really bad things happening if, you know, if something doesn't go their way, either explicitly or implicitly, right? And we see Trump making some of those moves there. At the same time, we've also seen this president come down from maximalist rhetoric in some other cases, again, notably in trade. So how that plays into a defense posture, I think it very much remains to be seen. But that's what we've seen from the president in some other circumstances. I would draw your attention to a really interesting item on the president's agenda for today. He's scheduled to have lunch with a top military leader from Pakistan. Now, that's an interesting thing. It was just announced with no fanfare and nothing about what might be on the agenda there. But it's interesting because Islamabad has very much taken up for Iran, has spoken in Iran's favor since this conference launched, but also has suggested it could play a sort of go-between role and maybe a mediating role between the U.S. and Iran and trying to find a solution there. So I'm going to be really interested to see what comes out of that. Is that a place for maybe Iran's message to get to the president's message to get to Iran, or is that maybe you know, something where Trump is trying to leverage Pakistan as a place to say, you know, maybe there are trade deals to be had if you don't get involved and if you don't provide Iran aid. How that goes, where that's going to go, I think is going to be a really interesting thing to watch that I think people may not be paying attention to, but it might be worth paying attention to as well.
Derek, absolutely spot on. Thank you for flagging that. We definitely will need to. Derek, thank you so much. That is Derek Wallbank. Coming up, a cyber attack at UBS. Data of more than 130,000 employees has been published on the dark web. We're going to have more on that and your front pages this morning coming up on your brief.
in case you missed it on Bloomberg Insight.
I just think there's a chance that you'll have stagflation. I'm not saying it's going to happen. I don't want the reader to say he's predicting that. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. With all those things taking place, yeah, you may be surprised.
I spoke to Jamie Dimon. He says that we should actually prepare for stagflation. How do you square that?
I think there's no question that the shock of tariffs are stagflationary. The question is going to be ultimately how high do they settle at? Right now they're at a very high level, highest in 100 years. And how long a period both is this uncertain environment and how long are the tariffs going to last? And the question now is the magnitude of the stagflationary impulse, and we just don't know yet.
Don't miss Bloomberg Insight live weekdays.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Welcome back to Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at the front pages this morning, what's making headlines in major outlets. First up, on the New York Times, Iran is said to be preparing missiles and other military equipment for strikes on U.S. bases in the Middle East. The Times cited American officials who have reviewed intelligence reports. U.S. commanders have put troops on high alert throughout the region. Next up, in the Swiss newspaper Le Temps, reporting that information of more than 130,000 UBS employees has been published on the darknet. Data includes the direct phone number of CEO Sergio Armati. A group called Hunters International is said to be behind the hack. UBS confirms that no client data was affected. And finally, the Financial Times reporting this morning that big tech companies are backing a lobbying campaign to pass a 10-year ban on states regulating AI. Google parent Alphabet and Meta declined to comment. Microsoft and Amazon did not respond to requests for comment. Well, a lot going on today, but it is indeed Fed Day. We're looking at U.S. futures up 1/3%, the dollar a little bit softer, 10-year yields little changed as we look at the back and forth between Iran and Israel and whether there will be escalation and whether the U.S. will get involved. Coming up, U.S. bank regulators plan to ease capital buffers for the biggest lenders. We're going to have more on that and the Fed decision. We'll be speaking with Citi's Andrew Hollenhorst. That's coming up next on your Bloomberg Brief.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Wednesday morning. Day 6, the conflict between Israel and Iran continues as speculation of a U.S. intervention grows. It's decision day. Jay Powell on deck as regulators attempt to ease strain in the bond market. And a hiring spree. OpenAI says Meta is trying to lure its employees away with an $100 million bonus. It was multiple things weighing on this market yesterday. A soft batch of U.S. data from retail sales and industrial products, both falling in May, plus the news flow of the past 24 hours. Are we seeing something that looks like more involvement from the U.S.? But we rebound this morning up 1/3% for the S&P, 1/4% for the NASDAQ. When it comes to oil, that also takes a leg lower after it reached its highest level yesterday since February. That's down 1 1/3% with no new updates overnight on the conflict in the Middle East. Your 2-year yield and 10-year yield are little changed at 4.38 for the 10-year yield. Let's get some stocks to watch now. Here with that is Joe Easton. Good morning, Joe.
Hey, Danny. So UBS taking a double hit in the banking space today. Firstly, we had a downgrade over at Morgan Stanley, cutting it to underperform. And then also news of a cyber attack at a third party. UBS saying that none of their client data, importantly, has been affected. It was more related to employee numbers. But that stock significantly weaker following that cyber attack and the downgrade from Morgan Stanley as well. Then we've got Airbus. Everyone having loads of fun over at the Paris Air Show. Unlike me, I've been stuck here. But the stock jumping today as the company Airbus says that they're going to increase their dividend potentially to around 50% of their profit over the next year. So decent move for that one today. And then finally, Peloton rebounding. This one was hit hard yesterday following concerns that you won't be able to use your taxable or non-taxable benefit, your health savings, to buy a Peloton or your gym membership. But that stock coming back up after an 11% drop yesterday. I'm yet to actually try a Peloton out myself. I have got gym membership that I don't use as much. But Peloton, nonetheless, coming back up today after a big drop yesterday, Danny.
It's such a 2020 thing. It's such a COVID thing. Peloton would hate us saying that, but it's okay. You don't need it now.
We've missed the boat.
We've missed the boat.
It's too late now.
Who wants to ride a bicycle in one spot anyway? Get outside, Joe, enjoy the fresh air, and ride a bike. I think that's the way to go. Joe, thank you so much for, as always, Joe Easton there with some stocks to keep an eye on this morning. Let's get you to a Bloomberg scoop now. The Fed, the FDIC, and the OCC are planning to reduce the Enhanced Supplementary Leverage Ratio, or the ESLR, for the biggest lenders, including JP Morgan, Goldman Sachs, and Morgan Stanley, essentially allowing banks to hold more treasuries. It comes after concerns that the rule constraining their trading in the treasury market led to more volatility. For more, Paul Davies, a Bloomberg opinion columnist for banking and finance, joins us now. Paul, just how much of a change is this for the treasury market?
Yeah, it should be very supportive for trading, I think, for banks' ability to, intermediate the market to take on treasuries and offload them again. I'm not sure that it will definitely lead to, a significant increase in the amount of treasuries that banks hold long term. I don't think that's really the point of what they're doing here. But it should improve, or it's designed to improve, the kind of the functioning, and the resilience and the liquidity of the treasury market in general.
Well, certainly from the Fed and the regulator side, it is that liquidity concern. The Treasury, though, has also been calling for this type of change, and they're more concerned with U.S. debt sustainability and Treasury yields. Paul, can it make a dent when it comes to that and when it comes to what we're likely to see in terms of larger auction sizes?
In terms of banks' ability to bid for, large slates of treasuries in auction, that should help. And in terms of, everybody's ability to trade treasuries, that should also just help in general, the kind of the yields available. But that's more because of an effect of liquidity rather than an effect of creating extra demand. I mean, Scott Bessent, the Treasury Secretary, has talked about this a bunch of times in terms of increasing the demand for treasuries. I don't think it necessarily does that among the banks themselves who are going to benefit from this capital change, but it might help improve demand among a sort of a broader array of investors who will have more assurance that they'll be able to, get in and out of positions when they want to.
Paul, thank you very much for that. That is Paul Davies of Bloomberg Opinion. Now, Citi Andrews Hollenhorst looking ahead to the Fed decision this afternoon, writing, quote, "We expect this week's FOMC meeting to mostly be a placeholder, with Powell continuing to advocate for a wait-and-see approach. But 3 months of slower core inflation data and the absence of any tariff-related price pressures through May leaves the door open for rate cuts later this year." Joining us now is Andrew Hollenhorst, Chief U.S. Economist at Citi. Andrew, does that mean this one's a snoozer? Turn off your coverage and look again in July?
Well, there's still something to watch, Rich. It is an interesting meeting in the sense that this is the meeting where the Fed will have fully incorporated tariffs into their forecast. So we should see the forecast for inflation coming up. We should see the forecast for the unemployment rate coming up. That would be including that tariff effect. But like we were writing about, it's very interesting because the inflation forecast is coming up, but the inflation data itself has been cooler. We actually have 3 months of cooler inflation now. So there is a question, what is Powell going to emphasize? Is he going to be more focused on this, tariff-related inflation that we may see later this year, or the 3 months of cooler inflation that we actually have in the data?
Do you also assume then, if they are starting to incorporate what their expectations are for inflation, that the dots will be different this time versus 2 last time of cuts?
I think what they're going to do with the dots is to leave them where they are. I think it's a little bit of a close call on the dots for this year. Right now, the median would indicate 2 25 basis point rate cuts. The risk would be that they shift that to just 1 25 basis point rate cut. But again, if we look at the inflation data that we have in hand, I think it's a little bit hard to be arguing that they need to get a lot more hawkish here. I think it is still this wait and see. And if you're waiting and seeing, you're trying to send a neutral message, best way to do that is just leave the dots unchanged.
Well, I guess the argument is that the data we've had doesn't fully incorporate tariff-induced inflation yet, that you had some issues with maybe a pull-forward effect that's also skewing this month after that starts to ebb. Is that a fair argument? Should the Fed be paying attention to the 4 months of data that shows softer inflation, or should they be ignoring it because you might get inflationary effects to come?
Having spent a long time forecasting the U.S. economy, I would say always take the data that you have in hand more seriously than your forecast for where things are going, because this is really the reality. And I think that's both that we have slower inflation, and if you look at where the inflation has been focused, this slowdown that we've had in shelter inflation, the slowdown that we've had in services inflation has been very broad-based across categories. So if there was a concern that we were going to have some kind of persistent inflationary pressure, even if we get some goods-related inflation later this year, I think we should be a lot less concerned now that that's going to turn into some kind of persistent inflationary problem. So I think there's a lot of dovishness in this data that we've had more recently. Is the Fed going to get there today? No, I think the easier choice for Powell is just going to say we're still going to wait and see.
Does that mean down the line, and obviously we're not there yet, this fear that the dual mandate's going to come under pressure, that we are going to see persistent inflation as the economy starts to weaken? Are you less concerned about that then because you see the inflation picture remaining a little bit more benign?
I think we should all be less concerned about that after the data that we've had. Yes, you still have to think about these scenarios where maybe we could get an uptick in goods inflation. But again, if we're just seeing it in goods inflation, that really is the one-time increase in the price level associated with tariffs. It's not this broad-based inflationary pressure.
What about higher oil prices? Should the conflict escalate in the Middle East? Does that hit the radar of the Fed? What will Jay Powell say to the inevitable question that he's going to get from the media as to how that impacts their forecast?
I think what he's going to say is probably similar to what I would say, which is that it's something that we're watching. We know that higher oil prices lead to higher gasoline prices, and that leads to higher headline inflation. But again, the question is, does this pass through more broadly into core inflation? If I was seeing a lot of demand pressure and a lot of price pressure generally in the economy, then I would think those higher gasoline prices, well, people will see that and they'll expect higher inflation and they'll ask for higher wages and we'll have this kind of cycle of inflationary pressure. That's just not really what's going on right now. And then there's also a question about, are oil prices even going to stay at the level that they are now? And the level that they are now is still significantly down from where they were not that long ago. So I don't think that the Fed is really going to have a big concern right now with oil prices, but they'll certainly say they're watching it.
There was some interesting data yesterday in the retail sales number, and the headline was bad. The control group was okay. Spending at restaurants and some of those discretionary items did take a big dive. I know the data there is a little bit noisy, especially when it comes to things like restaurant spend, but could that be the start of some finally slowdown in the American consumer?
It could be, and if you go back to the first quarter of this year, consumption held up fine. We did have a slowdown in services consumption in the first quarter after that data got revised. So, to your point, you kind of have to wait a while for the noise to filter out of some of this data. Right now, that retail sales report, we had big front loading of auto purchases, for instance, in March and April. Then that came off in May. That's part of the reason that we saw that big decline in the headline number. So I think it's really hard to take a strong message from that. But yes, we're seeing less price pressure in the services data. We're hearing about less demand, particularly in things like travel, airlines, leisure and hospitality to some extent also. That would be the restaurant. So I would want to see, are we going to continue that trend for another couple months?
I'd say the labor market has a lot of differing forces right now, and I think one of the more interesting ones is what's happening with AI. You have Meta saying that they're going to, or Sam Altman saying they're trying to poach people with huge bonuses. But there's also Andy Jassy of Amazon putting out a letter to its employees saying that AI is going to start to replace some of you, saying we're going to get more efficient, and it's going to mean a smaller workforce and a more efficient workforce. Does that start to impact the labor market? At what point do you start to see the real effects of some of the productivity gains and what also might result in a shrinking workforce?
Yeah, well, that's right. I mean, you say productivity gain, right? Productivity gain means doing more with less workers and less work hours. So that does mean that there are jobs and there are hours worked that used to be part of the economy that no longer are. I don't think that's having a huge macro effect yet. I think everybody's watching AI and saying, how fast is this going to move? That's what's really disruptive for the economy. It's not that we can't adjust to new technology. New technology is good for the economy. It's just if that transition happens very quickly, if you entered college training for a job, and by the time you get out, that job no longer exists, that's an issue. I don't think that's where we are now. What we do have going on in the labor market now is weaker hiring overall. And again, I'll go back to the new college graduates. You're seeing that in that data. Unemployment for new college graduates is coming up. We're seeing continuing jobless claims coming up. So there are some signs that hiring is very weak right now. I don't think AI is the biggest driver of the labor market at this point.
Yeah, fair enough. I mean, we'll get initial jobless claims today because of that holiday tomorrow. Andrew, thank you so much for joining. Always great to see you, especially on a Fed decision day. Andrew Hollenhorst of Citi. Let's now get you some other top stories that are trending on the terminal this morning. The Senate has passed legislation that sets up rules for cryptocurrencies pegged to the dollar. The legislation requires dollar-pegged stablecoins to hold dollar-for-dollar reserves in short-term government debt or similar products. It's seen as a landmark win for the crypto industry and President Trump. UK inflation remained at its highest in over a year. Consumer prices rose 3.4% in May from a year earlier. That's slightly above the 3.3% forecast. The BOE will release its latest decision tomorrow on Thursday. Shares of Nintendo rallying to a record after strong sales of the Switch 2. The game maker sold over 3.5 million units in the 4 days since it launched. Its arrival marks the biggest consumer tech product release of the year so far. Consoles start at $450. Coming up, missiles continue to fly between Tehran and Tel Aviv. We'll bring you the latest on the conflict raging on in the Middle East. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
No to military actions aimed at regime change, because no one knows what comes next. Haven't we collectively seen the consequences this has had in the region and beyond? Does anyone think what was done in Iraq in 2003 was a good idea? Does anyone think that what was done in Libya last decade was a good idea? No.
French President Emmanuel Macron speaking earlier. His counterpart in Washington, meanwhile, is considering all options on the table. President Trump posting on Truth Social, calling for Iran's, quote, unconditional surrender. Joining us for more is Bloomberg Horizon's Middle East and Africa host, Jomana Bercecci in Dubai. Jomana, a lot of questions about what unconditional surrender actually means. What is the U.S.'s aim and involvement up to this point?
And that's the big question that everyone around the world seems to be asking, especially after President Trump departed from that G7 summit rather abruptly, ostensibly to refocus on the situation in the Middle East. What we do know is that yesterday he had over a 1 hour call, or 1 hour meeting, I should say, with his national security team. There was no statement put out after that meeting, so unclear what went on there. He also had a phone call with the Israeli Prime Minister Benjamin Netanyahu. Again, no readout of that call either. So at this point, it is unclear what the U.S. president is thinking. However, if you look into some of the posts that he's put up on Truth Social after the last 24 hours, what is apparent is that his stance vis-a-vis Iran has become more hardened. You just spoke about there him demanding Iran's unconditional surrender. He spoke about the Ayatollah himself being an easy target, but that they're sparing him for now. He also said, we are in control of the Iranian skies, using the plural form, we, suggesting that the U.S. is already somehow involved in the action, in the strikes that are taking place. Of course, there is no military involvement yet to speak of, but that is the big question going forward. Will the U.S. president decide to go down the diplomatic route, bring Iran back to the table now that they are in a position of weakness, especially with the attacks on their nuclear sites, or does he go down the military involvement route, in which case he would assist Israel with those airstrikes, particularly on that Fordo nuclear facility, which is buried deep underground and very difficult to get to without the support of U.S. munitions. And remember, Danny, this is a U.S. president who campaigned on getting the U.S. out of, quote-unquote, forever wars in the Middle East, both in his first term and in his second term. He's got a big decision at stake here. And the other question that people have to think about as well is, what is the justification if the U.S. do get involved militarily? And two, what is the exit strategy?
Well, Iran, we've seen spokespeople there saying that Iran would respond to the U.S. directly if it is involved in the attacks. Jomana, what is the concern there? How do things actually escalate if the U.S. gets involved?
Well, that is, again, I think you need to go back to what the Iranian side have been saying. The Iranian ambassador to the UN this morning saying that at this point, they have not made any decision. But if it becomes apparent that the U.S. are involved militarily on strikes in Iran, then they would not hesitate to respond and to strike back on U.S. assets. And so it is actually taking things one step further. It will be seen as a dramatic escalation, and it really does run the risk of broader confrontation and conflict in the region as a whole. Remember, the U.S. has 9 installations dotted around the region. All of those could potentially become targets in a situation where the U.S. decides to intervene militarily. So very precarious situation, Danny.
Jomana, thank you so much for your excellent coverage. That is Jomana Bersachi in Dubai. Turning now to tech, where the competition for talent in AI is heating up. OpenAI Sam Altman says that Meta, which is reportedly building a superintelligence team, has offered some of his staff signing bonuses as high as $100 million. Speaking on a podcast, Bloomberg's Charlie Wells is here with us. Charlie, $100 million, and that's just the start. Meta is trying to spend big.
Yeah, so look, that doesn't even include the annual compensation figure. And this really just speaks to the fact that there certainly is a race for talent in the AI space. And if you think about what Meta is doing, you can look at some of the components of what makes a successful AI company. It's chips, it's data, and it's talent. And Meta has the chips. They definitely have the data. They are really on the hunt for talent right now. And Mark Zuckerberg reportedly is not happy with the status of Llama 4, their large language model right now. And so he has been going around to a lot of these other competitors and trying to poach talent and doing so successfully, but also making these significant offers. He's also been bringing something of a personal touch to these poaching efforts, inviting candidates to his homes in Lake Tahoe, in Palo Alto. And this just speaks to how important it is to get that talent. And some executives have actually told Bloomberg that these pay packages, astronomical as they may seem, actually could make sense because the number of people who can actually deploy these AI skills is so small, but so important for these companies as they try to race ahead of each other.
It's crazy because it really wasn't that long ago. It was only a few years ago we were talking about Meta and Zuckerberg's year of efficiency, and it seems reward investors, to your point, Charlie, are okay with so much money being spent. We also heard that xAI, Musk's AI venture, has been burning through $100 billion a month. Is there an element, Charlie, where they have to spend? They have to spend to keep up and not get replaced as technology quickly changes.
Well, that's the story that we're hearing, and it's interesting because just a few months ago, remember, there was so much concern about CapEx for these AI companies when you had that DeepSeek threat come in early in this year. That narrative, at least in the market, seems to have been dissipated or forgotten, and it's really interesting because if you look at Meta, you see them spending big on talent. If you look at XAI, you really see them spending big on infrastructure, on actually buying instead of renting the chips that are necessary for this technology. So that speaks to sort of differing strategies here, but looking at XAI and trying to differentiate between some of the other firms, they have a little bit of a revenue issue, right? So they are expected, at least according to people who have seen these financials, to bring in some $500 million this year. Compare that to OpenAI. They're expected to bring in some $13 billion, according to people familiar with the matter. So a bit of an issue there, but this in a lot of ways is classic Musk, right? What he tends to do with these businesses is spend a lot early, invest a lot early, not worry so much about revenue, and then reap the profits later.
Fair enough. By the way, Charlie, I might have said they're burning through 100 billion. I definitely meant 1 billion. 100 billion would actually be like bananas crazy numbers. Still a lot of money. Let's be clear. Charlie, thank you so much for joining. That is Charlie Wells. Coming up, jobless claims data coming in early ahead of the holiday, plus a Fed decision on deck. All of that, we'll have your trading diary for you next on your Bloomberg Brief.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
This is your Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day on this Wednesday. Jobless claims data that comes in a day early, 8:30 a.m. Eastern, due to the holiday tomorrow. Then we're going to get U.S. housing starts and building permits. That comes at 10 a.m. And the Fed announces its rate decision. That, as always, is at 2 p.m., followed by Chair Powell's press conference at 2:30. Now, some individual movers for you in the pre-market. Tesla is somewhat higher this morning, about 9/10. It closed down almost 4% yesterday. A lot of volatility there ahead of their robo-taxi launch this weekend. Circle, that's gaining more than 3%. The UN Senate passed a stablecoin bill setting up regulatory rules for cryptos pegged to the dollar, so some excitement there. Finally, Peloton, that's higher by 2%. Again, this is a bounce back after yesterday. It tumbled double digits on Tuesday as a Senate bill omitted the use of some HSAs for some fitness allowance. All right, a quick check on oil as we head into the end of the hour. It is lower this morning after gaining yesterday to the highest level since February. Currently 1% lower. Is no news out of D.C., at least when it pertains to Iran-Israel. For now, we'll see if that changes. That is it for your Bloomberg Brief. Surveillance takes things from here.
We'll have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board. I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bring you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
The Fed is going to take its cue from the path of trade policy.
Inflation is the element that they're concerned about.
We know that they are baking in some weakening in the labor market.
They're definitely going to be on hold and evaluating.
In the near term, it makes sense for them to be on hold.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome to Bloomberg Surveillance. It ought to be Fed Wednesday. That is what we would say normally, with the U.S. Central Bank delivering a rate decision forecast. Or normally we'd point to jobless claims and housing starts due out later this morning, with weakening trends taking hold across a number of economic indicators. But all of that is second fiddle today as the war between Israel and Iran enters its 6th day with an increasing focus on the U.S.'s role in the conflict. Will the U.S. get more actively involved, Anne-Marie? And that is really the question after yesterday's meetings with President Trump.
Well, President Trump is giving Iran an ultimatum right now, and he's basically signaling you have to make this decision to give up nuclear weapons plans or the progress potential path to this enrichment to make a nuclear bomb, or we will make that decision for you. And he's doing that by fortifying the military, sending the U.S. aircraft carrier into the region, sending a number of jets that can help with refueling. So he's messaging, we are prepared and could do this. The White House and the president certainly understands the consequences, though, of interventions. I don't think it's a decision he will make lightly. He did meet with his national security team yesterday. He had a call with President Netanyahu. And at the moment, the world is just waiting with bated breath, basically, to see what the United States decides to do.
The world and, frankly, markets, which can't really price in the uncertainty that just keeps coming in waves of new data points and new narratives that we get every single day. It raises the question for the Federal Reserve as you face off with this question of how do you price in inflation from tariffs? How do you price in inflation from potentially some sort of disruption in the Middle East? And how do you understand the slowing growth that we have seen with recent economic surprises coming in negative?
I was just speaking to Andrew Hollenhorst in the pantry, and he was on about a half hour ago. And what he said to me was basically, if the Fed right now didn't have all this uncertainty in terms of tariffs, but they were looking at the hard data, would they not be having this meeting and saying, now is the time to cut? We've had consecutive reports that inflation is coming down. Why would now not be the time to cut? It's because they have this overhang, this cloud of this uncertainty when it comes to the tariff rates and what that might do to inflation and potentially an inflation spike spiral.
People are already sensing that maybe they will be cutting rates at least once or maybe even twice later this year. Right now, when you take a look at markets, you could see this quiet feel across the board, a little bit of a rally trying to regain some of what we lost yesterday, up almost 1/3% for S&P futures. Yields lower, and they've been lower for a number of consecutive days. 10-year yields 4.38%. You could see a similar type of move in the 2-year space. And oil prices, this is important, down almost more than 0.5% as people game out exactly what the U.S. involvement will be in the Middle East. Coming up this hour, Julian Emanuel of Evercore ISI as stocks tick higher ahead of that Fed's rate decision. George Saravelos of Deutsche Bank as the dollar snaps a 3-day winning streak, and IAEA Director General Rafael Grossi as Israel attacks nuclear sites. We begin this hour with our top story, Israel and Iran entering a 6th day of conflict, the White House weighing direct involvement. Joining us now from the Middle East is Bloomberg's Jumana Bersachi. Jumana, what's the latest?
Yeah, well, just as Anne-Marie was saying, the whole world is waiting to see what the U.S. decision is on whether to get involved militarily. Remember, President Trump departed G7 summit rather abruptly yesterday, ostensibly to focus on the situation in the Middle East. And this time, yesterday, he spoke about looking for something bigger than a ceasefire, which sort of opened up a sliver of hope that perhaps he was thinking about the diplomatic channel and perhaps re-engaging with Iran and bringing them back to the table for this nuclear deal. However, the stance has taken a lot more of a hawkish direction in the last 12 hours or so. If you look at the post that he's put up overnight, he's talked about demanding Iran to surrender unconditionally. He's talked about we having control of the skies and using the plural, suggesting that the U.S. are somehow involved already in the attacks that are taking place. And then has talked about knowing the whereabouts of the Ayatollah and sparing them this time around, i.e. suggesting that the U.S. could target the Ayatollah should they choose to do so. And so at this point, the U.S. president has to make a decision about whether or not they do want to get involved militarily. His advisors seem to be divided on this issue. He did have a meeting yesterday with his national security cabinet. There was no readout of that interview, of that meeting, I should say. He also had a phone call with the Israeli prime minister. Again, we don't know what went on in that call, but what we do know is that the whole world is waiting to see what the U.S. decides, because it does run the risk of turning this into a more regional conflict, especially because the Iranian side are saying that they're watching very closely, they're monitoring the U.S. involvement, and they would not hesitate to react in a proportionate manner should they see that the U.S. are getting militarily involved as well.
Jumana, a lot of people keep talking about regime change, but this isn't Lebanese Hezbollah or Hamas. This is a government with thousands of people in it. When people say to you regime change, what does that look like?
I think at this point, a lot of that comes down to wishful thinking. Remember, this is a country of more than 90 million citizens. And as you mentioned, those senior commanders, IRGC, have a stronghold over the population. They have not allowed for any opposition, any dissent in the last couple of decades. So it's unclear at this point who necessarily would take over should there be a change of leadership. And then there's also the parallels of history. You don't have to go that far. President Macron talked about it yesterday on the sidelines of the G7 summit. He said, we all remember what happened in Iraq after 2003. We remember what happened in Libya. Even today, you're still feeling the effects of military intervention in Libya with all various tribes and factions fighting amongst themselves, no clear leadership on the back of that. And so there are parallels to be drawn from history of what happens when there is forceful intervention and an attempt to remove leadership without a viable replacement and without viable institutions in place. So there's a real fear in the region that the military objectives are not just military objectives, but the ultimate goal may be actually regime change. But at this point, it's unclear what that may lead to, and there is a real fear that it could actually bring about more chaos in the region as opposed to more stability.
Bloomberg's Jumana Persechi, thank you so much for the update. Right now, let's get the view from Wall Street this morning. Julian Emanuel of Evercore ISI writing, with this backdrop, no surprise by the Fed. It could be the biggest surprise of all, depending on how the news on everything else breaks. The one thing we do know is that the call to lower interest rates will ring loudly once again. Julian joins us now, and before we get to Fed, the other story in the room today, we have to get to what we've just been talking about, which is how much what's going on between Iran and Israel does have ramifications for markets.
There's no question it does. And I mean, look, we're looking at our Bloomberg monitors, all three of us here, waiting and understanding that Khamenei is about to make a speech that who knows what that path is going to look like. But as investors, this is one of these times where you have to understand what you're trying to achieve in your portfolio and try and filter out the noise, as difficult as it is, given the fact that when you look at this year, markets have gone through the entire range of emotions. You know, it started very exuberant, then outright panic, and then when we figured out that there wasn't going to be a recession, you know, really exuberance once again, and now it's time for patience.
But this potentially is a seismic shift in the region, not just noise. What do you do with that?
You stick to your knitting, and if you're an active manager, you have to think about ways to stay invested but hedge, okay? And look, the fact is there are so many different paths that this could go down, and obviously one of them could be an ultimate de-escalation. Obviously, no one has said anything about regime change. You know, I'm hearkening back to when I was a young man, seeing what happened in 1979. Who knows if that's the ultimate outcome? But again, just going back to the fact that as an investor, you have to think, first off, that there's likely to be a larger premium in the oil markets than there was 6 weeks ago, when, you know, frankly, it seemed a little weird that the price was as low as it was, given the fact that we're not in a recession.
So let's take a step back. If it weren't for what's going on between Iran and Israel, we'd be talking about the economic data. We have seen the U.S. Economic Surprise Index, at least by Bloomberg, roll over to the most negative that we've seen it so far this year. We have seen a series of economic data points that have shown this weakening trend. Is there increasing pressure on the Federal Reserve right now to signal some sort of dovish bias, this idea that all things being equal, putting these disruptions aside, there is something that's happening here that they should be responding to?
Well, look, and again, you look at the weekly jobless claims, they're the highest they've been in a number of months, but by absolute standards, they're still very, very low. And we're talking about an unemployment rate, again, in the low fours. And this is one of these times where the Fed is going to remind us all that the dual mandate really is a dual mandate, and that most people, Evercore ISI included, believe that inflation is going to tick higher, you're going to have a 3 handle later in the year.
So talk to us about the bull market call that you've had and what it sort of is predicated on. Is it the idea that inflation will be somewhat sticky, but growth will also be better than it certainly is showing right now? Is it this idea that all of these other issues that we're talking about are going to get resolved? I mean, what's the base case in terms of how much this market can look through? Because right now, the resilience has just rather been shocking to a lot of people.
Well, no question about it. And I think, and this is part of the issue to us, we've had several months now, and obviously the last batch of inflation data was much more positive than people expected. We're not entirely certain that if, in fact, the data does deteriorate as we and others expect, that the market won't get a little bit perturbed by that, because you've had these months of sort of being lulled into a belief that maybe it won't happen. From our point of view, this is one of these secular times where the technology's advances are going to ultimately bleed into a greater level of productivity. It's no coincidence that we're seeing companies across a slew of industries talk about AI implementation actually being able to drive revenue. That was the thing we were all wondering about last year. It's starting to crystallize. And in that environment where their liquidity is still ample, you can support higher stock prices, plus the earnings trajectory remains rather solid.
What's your North Star as we look at all of the potential competing narratives right now?
For us, it continues to be this idea that the elements that end bull markets are not in place. Recession, the Fed is not going to hike whatever the inflation number is. We think that consistent with every bull market, you're going to have a period of greater speculation and greater capital markets activity, and that's still ahead of us.
Julian Emanuel of Evercore ISI will be sticking with us for the hour. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. We start with the latest out of the Middle East. Iran and Israel exchanged fire for a 6th day. The IDF said it identified missiles launched from Iran and intercepted most of them, while Israel said it hit a facility that made centrifuges for uranium enrichment. The New York Times reported that Iran was preparing missiles for retaliatory strikes on U.S. military interests in the Middle East if President Trump decides on an offensive campaign. Meanwhile, the Supreme Court is being asked to weigh in on President Trump's economic agenda. 2 family-owned toy companies are asking the High Court to consider striking down many of the president's tariffs. They argue that the massive impact on businesses and consumers requires immediate intervention rather than waiting for a federal appeals court to rule. And Amazon CEO Andy Jassy says he expects the company's workforce to decline in the next few years as it uses artificial intelligence to handle more tasks. In an email to staff, Jassy says the technology will mean fewer people in some of today's roles and more people doing other types of jobs. Jassy says he expects that will lead to efficiency gains across the company. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. We'll be talking more about that coming up, something people have been speculating about for quite a bit. Up next, we're going to be speaking about increasing pressure on Iran.
Up to this point, the policy of President Trump, and candidly every president before him since Iran has had a nuclear program, is that Iran will not have a weaponized nuclear program.
Joining us next, former White House fellow Elliot Ackerman with more about what exactly is going on with assets building in the Middle East. This is Bloomberg Surveillance.
is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
This is a market that likes to shrug off any potential risk, and that seems to be what it is doing this morning. After declining yesterday, we are seeing a bit of a rebound, up about 0.25% on the S&P. You're also seeing a bit of dollar weakness as people take a look at just what this means going forward. 115, we've been hovering around that level for euro dollar for a while, and yields lower across the board, 2 10s and 30s, with 10-year yields at 4.38%. Under surveillance this morning, increasing pressure on Iran.
Up to this point, the policy of President Trump, and candidly every president before him since Iran has had a nuclear program, is that Iran will not have a weaponized nuclear program. This world needs less nuclear-armed countries rather than more. And if Iran, Saudi Arabia, the UAE, Turkey have nuclear weapons, that's a level of instability that I don't think we want to undertake.
Here's the latest. The war between Israel and Iran continuing for a 6th day. President Trump weighing his options in the escalating conflict. Trump calling for Iran's, quote, unconditional surrender before his meeting with his national security team. Bloomberg's Akayla Gardner joins us now. Akayla, can you give us a sense of what the consensus is right now in Washington, D.C. about what the U.S.'s role should be?
Well, yesterday, President Trump met with his national security team for more than an hour, but he's been pretty quiet since that meeting, so we still don't know exactly what path the U.S. is going to take, but we have seen his rhetoric sharply increase in the last 24 hours. He has gone from talking about a diplomatic solution with Iran to negotiate over their nuclear program to now really using assertive, aggressive terms. He talked about an unconditional ceasefire. He also mentioned knowing the location of Iran's supreme leader and saying that there's complete control over Iran's skies. And you saw Vice President Vance yesterday very explicitly leaving the door open to the U.S. getting involved in some of the attacks that we've seen Israel already doing on nuclear facilities. And yet, at the same time in Congress, there's really concern about the U.S. getting into a longer-term war here for years, as we've seen in the past, the U.S. getting drawn into these conflicts. So Congress is really seeking to limit the president's powers here using the War Powers Resolution, and yet to see what President Trump's response is to that specific resolution.
Bloomberg's Akayla Gardner, thank you so much. We'll be catching up with you in just a bit. Joining us now is former White House fellow Elliot Ackerman. Elliot, thank you so much for being with us. Really looking forward to hearing your insights. First, what do you think is happening? And what do you think the U.S. is waiting for as they deliberate over what their actions should be with Iran?
Well, I imagine, at this point, there's significant coordination with our Israeli allies as they degrade Iranian capabilities. And I imagine there's a lot of back channeling amongst our allies that we would be going through before launching any type of decisive strike against Iran's nuclear facilities. So, that's assuming the decision has been made. I'm also not confident that the decision hasn't made yet. President Trump might be waiting for conditions on the ground to continue to develop.
I'm also not confident a decision hasn't been made. It feels like he's trying to give Iran an ultimatum. Could you see potentially him just trying to use this and get Iran back to the negotiating table?
Yeah, it would certainly align with how President Trump has behaved in the past and the tactics that he uses, including, unconditional surrender, which is obviously a somewhat vague term, and threats against Khamenei. So I think we sort of have to watch and see how this will play out. But I think, unlike U.S. military involvement in the past, and for instance, Afghanistan or in Iraq, the type of military intervention that's being discussed is, much more limited, much more precise, particularly in what its objectives would be.
Elliot, then how does the United States prepare for the retaliation that they could expect from Iran?
You know, the main retaliation that's being discussed and that would be within Iranian capabilities is a strike on U.S. assets abroad, specifically military assets. And we've seen this in the past. And, you know, other times when Iran has launched these type of retaliatory strikes, you know, candidly, they haven't been particularly effective. So we'd have to see, you know, the U.S. is deploying assets into the region that not only could be used to strike against the Iranians, but could also be used to provide a greater measure of force protection to those assets. You know, but that's really the main Iranian capability that we would see used against the United States.
When you look at the posture that's changed now in the region over the course of the last 48, 72 hours, do you think the U.S. is in a place that is actually prepared if it was to go for that strike offensively as well as preparing defensively for the retaliation?
You know, we have the potential to get these assets in place pretty quickly. You know, and obviously, sort of the main offensive action that's being discussed would be a U.S. strike against the Fordo nuclear capability, which is that Iranian nuclear facility that's very deep underground that the Israelis don't have the capability to destroy. And so those assets have been moved into the region. And, you know, I think it's really giving President Trump the options should he use them to launch that type of a strike.
Elliot, curious to know what you think Israel's role becomes if, in fact, this is a maneuver to get Iran back to the negotiating table.
I think, you know, listen, when we're looking at this conflict, this is a war between Israel and Iran, and, you know, discussed U.S. participation is really, at this point, to give Israel the capability to just launch more intense strikes. You know, and then ultimately, these wars sort of end in one of two ways. You know, one would be the Iranians coming to the negotiating table, and the others would be a potential collapse of the Iranian regime. So, you know, those are both potentialities. And at the end of the day, I think Israel will be leading whatever the end of hostilities look like, with the U.S. in more of a supporting role.
Do you think that there is a scenario, Elliot, where the U.S. and Israel could take out all of Iran's nuclear capabilities without some sort of massive regime change at the top?
You know, it's tough to say with these things because it's very difficult to get a good handle on internal politics in a country like Iran. I mean, so often when these regimes collapse, it surprises so many of us. And conversely, there's so many regimes that seem to hold on despite all of the odds. But listen, everyone is certainly putting their cards on the table. What we've seen with Israel's war, you know, not only this war in Iran, but also in Lebanon, is that many of these regimes and their proxies are far weaker than we have supposed. And I think this is putting massive strain on the Iranian regime in a way I haven't seen in decades, if ever.
Elliot, though, isn't also the concern that they could just be replaced by individuals around them who are even more to the right of where they stand?
And listen, that is always the concern. I mean, that's why they call it the iron dice of war. That when you go to war, you're taking a big chance. And I think the chance is, yes, you could have more extreme elements. You're creating a vacuum, and you don't necessarily know what steps into that vacuum. So, you know, President Trump, Israel, you know, are all stepping into a massive realm of uncertainty.
Elliot Ackerman, former White House fellow, thank you so much for being with us as we try to figure out what exactly the next steps could be. I'm struck by, Emery, the fact that we really don't have a sense of what exactly could happen. And right now, people are just assuming, look, if something happens, it's not going to disrupt everything that much so that it would actually disrupt what's going on currently in the U.S. economy.
Right. Of course, although if Iran does decide to do something they've threatened for years but never actually took the step to do, which is to close the Strait of Hormuz or make it very challenging for tankers to go through the Strait, where a fifth of global oil supplies and some also LNG supplies go through. What I find so interesting about the conversation is when you speak to Israelis, they leave that door open, that possibility, that hope that there could be regime change. When you hear from the President of the United States, he has made it very clear for years that he wasn't really going after regime change. he says Iran cannot have a nuclear weapon. So I think when you think about why the United States would want to get involved, it's to go after these places where Israel just doesn't have the capability, but where they are concerned that Iran has that uranium enrichment.
Julian, how much are you watching this to try to get a sense of how it will have ramifications potentially for the U.S. outlook?
You're watching it incredibly carefully. And I mean, as that conversation was occurring, we saw the futures markets ticking down. And I'm thinking to myself, are there headlines that we haven't just seen yet? It really is one of those things that, again, against the backdrop of a market that's expensive, it is a major, major consideration.
Well, coming up later this hour, we're going to be speaking with the IAEA Director General, Rafael Grossi. Do not miss that as we try to understand what the ramifications are for the Iranian nuclear program. This is Bloomberg Surveillance.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
If there were a phrase for markets in 2025, perhaps it would be uncomfortably numb, at least right now, because what we're seeing is a real level of calm in markets, even with a whole slew of very dramatic headlines. Despite what we're hearing about a sixth day of conflict, of war between Iran and Israel, we are seeing futures up just slightly, hovering very close to those all-time highs, up about a 0.1% on the S&P, and the NASDAQ up about 0.25%, 3 hours away from the cash open. Here are your morning movers with Danny Berger. Danny.
Hey, Lisa, you have a lot of stocks this morning and indeed yesterday moving off the back of what we got out of Washington, D.C. Circle, it is a stablecoin issuer, up nearly 3% in the pre-market trade. That's because the Senate has passed legislation that is around stablecoins. The hope is it becomes more mainstream, basically says that for stablecoin issuers, they need to hold dollar-for-dollar assets of short-term government debt. So that excitement there for this stablecoin issuer, up 2.7%. That bill now goes to the House. Now, yesterday, it was the big, beautiful bill that captured the attention of some of the stocks like Tesla yesterday. The fact that you had a quicker phase out of some of the clean energy tax incentives, that meant that Tesla fell nearly 4%. It is rebounding this morning, but I got to say that rebound is starting to ebb. It was up nearly 1% at one point in the pre-market, now just up by 0.6%. Same goes for Peloton. In the legislation, in the House version, there had been legislation that said if you have an HSA account, you can use it on spending on fitness things like Peloton. However, when the Senate released the bill, that was gone. So we saw Peloton sink double digits yesterday, but again, we are buying the dip this morning. Those shares up 2.2%, Lisa.
Thank you so much, Danny. Meanwhile, on our radar this morning, as we've been talking about throughout the morning, the Israel-Iran war entering its sixth day of conflict after President Trump met with his national security team, fueling speculation that the U.S. is on the verge of joining the attacks. And Anne-Marie, one thing we haven't talked about is just the conflict within the Republican Party about whether or not the U.S. should be more involved.
Right, there are many on the far right, the MAGA base, the likes of Tucker Carlson, even going after Senator Cruz in his most recent podcast about why the United States would want to get involved. President Trump has said he does not want any foreign wars. He wants to untangle America from global conflicts. Why would you want to intervene? But the president also has been very clear for years that Iran cannot have a nuclear weapon. There's something happening today that I think everyone should really be paying close attention to. The president will be sitting down with Pakistan's army chief. This could potentially be someone that could be an interlocutor that potentially when the president says there's an ultimatum, where either you make that decision or we're going to make it for you. I think what comes out of this meeting could be very telling on where the president's thinking is right now.
Yeah, who wants to be the mediator? It seems like everyone's kind of raising their hands. Meanwhile, this story would be getting a lot more attention if it weren't for what's going on in the Middle East. U.S. bank regulators planning to lower capital requirements for the country's biggest lenders. Sources telling us here at Bloomberg, they plan to cut the enhanced supplementary leverage ratio and will apply to banks like J.P. Morgan, Goldman, and Morgan Stanley. Julian Emmanuel is nodding his head along, and I have to say, this was possibly the reason why we saw a real rally into the long end of the Treasury curve yesterday, as people speculate that maybe this would open the door to banks owning more Treasuries.
Well, I go back to March and April when we were getting questions multiple times a day from clients saying, does the Trump administration actually not mind a recession in order to keep long-end bond yields suppressed? And we thought that was ridiculous, and the market figured out it was ridiculous in April. But the fact is that they understand very, very well, and they're going to understand it even more when the big, beautiful bill gets passed and the deficit continues expanding, that they're going to need to do everything they can to keep yields under control, and this is a big step.
Yeah, at this point, though, it's unclear why big banks would want to own more long-term treasuries at a time when so many companies have come out and said, actually, long-term treasuries are a risk asset.
Look, the liquidity provision function, however it evolves, is very central to this narrative of the United States remaining the premier destination for capital, and this is going to help at the margin.
Meanwhile, what might not help at the margin is a question around whether we have jobs. Amazon CEO Andy Jassy expecting a workforce decline in the next few years as it uses AI to handle more tasks. In an email to employees, Jassy saying they need fewer people doing jobs that are being done today and more people doing other types of jobs. Amory, I know you've been really big on this story. We all have. It's a real question of how much artificial intelligence is going to transform our workforce.
Absolutely, and it feels existential almost if you're reading this, I imagine, especially if you're sitting behind that email at Amazon. what is that job that other people are not doing right now? I think that's the big question that lingers and people are concerned about. But remember 3 weeks ago, Anthropic came out and talked about how basically when you have white-collar jobs, those entry-level jobs are going to be absolutely decimated. This is going to really impact politics. Actually, Steve Bannon in his War Room podcast has been talking about this. No politicians are paying attention to this. If people start losing their jobs, and it's because of AI, people are going to start to say to politicians, where were you? Where were you trying to protect where we were? And I think you're going to see more emails like this from Amazon. It's going to become a much bigger political issue.
When you say, where were you? The politicians might say, we've been focusing on the one big beautiful bill. We've been focusing on what's going on in the Middle East. When you take a look at what's going on in Washington, D.C. and that big beautiful bill, the Congressional Budget Office saying the House-passed version would add $2.8 trillion to the deficit over the next decade. This as the bill moves through the Senate. Vice President J.D. Vance pushing the chamber to pass it by the July 4th deadline. Joining us now is Wendy Schiller of Brown University. Also in another world, we would be focused on this in terms of what the ramifications were for the deficit, for debt rates in the United States. How much do you see this as actually getting passed by July 4th?